Oops. There we go. It's a live person. Where you can find that again. It's in the Relink book, and I've updated the Relink book. Well, I didn't, but the Real Estate Commission came out with a new one as of 2023. The only difference, I think I've mentioned before, is really that you can't take the PSI test online anymore. You have to do that in person. And it just reflects that. And it's about the only difference. But you'll notice it says February 2023 at the bottom. The first one I gave you was, I think, March of 21. They do not come out with these every year, just as they need to. But let me go ahead and put that in the chat just in case. But I'm pretty sure it's in the Google Drive for you. And there we go. That'll be the way that you understand the procedure, right? The Relink book is all about the procedure of the licensing process. There are some testable items in here, by the way. But what I want to call your attention to as a reminder is the background check. Once you submit your background check and it comes back, it's good for 180 days. 180 days. So that would give you time to have to retake a section or two if you needed to. So that's why we say to go ahead and do it around the midpoint of the course, so that by the time it comes back, it's around the time maybe the course is finished and you still have time left with it. So just keep that in mind. You could wait, but I can't promise you how long it's going to take for it to come back for you, because that's going to depend on how many places you've lived and how many names you've had. Both of those things depend upon the cost it will be and the location, and military people particularly, right? Going to have a few more places maybe along the way for that search to have to take place. So here it is, page 10 of the Relink book. You can see the actual website. It's not just any old background check. It's got to be done at this website, that particular one. And when it comes back, it will arrive to you, and at the same time arrive to the Real Estate Commission. But they're not going to do anything with it. They're just going to hang on to it until they get notification that you have taken and passed the PSI exam. That's when they'll care about it. At that point, they will look at it, ask any questions they might have about character clarification. Sometimes people are worried about some thing that happened in the past, and will that keep me from getting my license? Will that be a character problem for that investigation? And the advice from the Real Estate Commission is usually not, unless you don't mention it and they find out through some other means other than you. So don't hide it. Don't try to hide it. It comes out and then it looks bad because it looks like you tried to hide it. So if you're worried about a particular item, by the way, you can actually pay, I think I mentioned it the first week, something $45 for something called a petition for predetermination. And they can look at your situation, hear you out, and tell you if it's even worth the trouble, right? If it's something that's just too much for them to be able to overcome and therefore give you a license. So those are just a little recap of what we've talked about once upon a time. And then, of course, the other useful part of this Relink book, besides the whole procedure and what the sections look like and the pass rates and the type of questions, all that good stuff. Don't forget to look this over and get familiar with it, is the chart. And so what we're covering tonight is finance, real estate financing, 12 questions on the national part of the exam. So definitely a big ticket item. We've already talked about basic contract law. That was 13 of them. We've already talked about brokerage, which was 10 on the national, 11 on the state portion of the PSI exam. And I have to believe, but I can't confirm, but feel like that the class exam is probably pretty similar in terms of how many questions from which topics. So it's also useful for the class exam as well. At the end, after we've done finance and then closing procedures and then valuation, after we finish those, here we go. Here we are at finance. Probably going to finish that tonight pretty much. Closing the transaction, valuation. Then we'll get into a handful of smaller chapters. Little half hour, 1 hour, 2 hour chapters. And that'll be how we end the course. And the very last section is the license law and commission rule, which, by the way, we have pretty much covered. And by the time we get there, we will have completely covered. So those days can turn into more of a review time because we will have pretty much handled all that license law commission rule. So just keep on in that order. Let's see. Syllabus section, we're on 11, happens to be chapters 14 and 15 from the book. But then syllabus 12, 13, 14, 15. Yep, it's all in order. That's right. Of the syllabus, but not necessarily in order in the textbook. Don't forget that. Don't let that throw you. And then again, the math. We're going to get more into math over these next two chapters. Finance tonight, and then closing the transaction tomorrow. A lot of calculation stuff. So buckle in. And these are 8 calculation-related questions they're talking about on the PSI. That doesn't mean that they're not going to ask any more than 8 math questions, though. They can ask math questions that don't require you to use a calculator. And it might look something like this, and this will make more sense once we actually get into it, but here we go. It might be something like talking about property tax. And we'll touch on that probably tomorrow. But the answer choices will be like, how much do we attribute property taxes to the parties? $560 will be a debit to the buyer and a credit to the seller, or is it $2,100 as a debit to the buyer, credit to the seller, or credit to the buyer? What I'm talking about with credits and debits are expenses and income. That'll make more sense when we get along there. But think of it like your checking account, literally like your check card. If it's a debit, it's going out. If it's a credit, it's coming in, right? When somebody overcharged you for something and or you return an item to maybe Lowe's or Home Depot and they want to credit it back to your account, that's money coming in, right? So that's a credit versus a debit. And so, see, what they could do is just not make you have to come up with the numbers, but you would just have to know which number, the big one or the small one, counts. How would we handle this, right, on this given math problem? So there's a way they could ask you math without you needing a calculator, and we'll talk more about that. But those are 8 calculation-specific problems they're talking about. Okay, and then another thing, I wanted to remind you, if you haven't been, there is the recap. Well, it's not a recap, it's the entire class session. But if you go to that Ask Neil Pender YouTube channel, I hate that they do it this way. The home screen just shows the 2 recorded videos. You have to click on the headings and click on the live heading, and then you'll see all of the many live course classes recordings that there are. There are some for every one of our classes we've had together, and there are some for every one of my previous pre-class that I taught for Go School a couple months ago. So you got both. Same content, just different time. And, sometimes I talk about different things, but essentially the same stuff out of the syllabus. I might just use different examples from time to time. So don't lose track of that. There's probably a way I could set that to home. I just need to dig into it. But click on live and you'll see all of them. And then the other thing, because now from here forward is going to be a significant portion of your time should be review. A lot of review. You need to spend time outside of class doing your review. And here is another channel that I've made with also more content. But this one has, if you click on the video tab and go all the way to the bottom, the oldest ones from a year ago are the math. And then a couple of the ones with my face are specifically like math tutoring sessions that I've recorded too. So as you get into those of you who might have a little math grudge against the math, here's your friend. You can pause these guys, right? You can pause them and work your way through them. And you can always ask me questions too. Along the way, just shoot me questions, text, emails. Happy to point you in direction and record something for you. I've done plenty of those. Here's one. Somebody had asked me a question and I just real quick sat down and did a Q&A and just sort of walked them through it. It's a different book for that particular class because this is a different school, but same content, just a little different approach. And since we're on the topic, speaking of other schools, you may have run across this guy, Travis Everett. He's got a lot of content, and he runs a school out of Cary. And he's got, I think, a current class or in the last couple of months at least. And he uses our same yellow book. So you can kind of get a whole different approach from his viewpoint. Different slides, different approach completely. So all of it's good, right? It's worth it to maybe spring for the, $13 a month YouTube premium that lets you turn your screen off on your phone while still hearing the audio from the video, right? You can just listen to the video instead of watch it. And I do that all the time. Walking the dogs, doing housework, whatever, exercise, running, whatever it may be. And it's just another way to get it in there, wedge it in that brain. I found it really useful. What else? We left off with finance. So let's do a little bit of catch up. And we talked about how loans work, right? The idea of borrowing money to purchase a house, you're making a house payment. And from that house payment, if it's a fully amortized loan, a little bit of that house payment is going toward your principal, meaning paying down the principal. Like here we are in month 1, you can see there. Month 1 through, it'd be probably the first half of the mortgage. All of them are going to be a bigger portion of any given monthly payment going toward interest compared to principal. They stack it that way. The lender stacks it that way so that what you're paying them in the beginning, the first part of the loan, gives them the most money soonest, gives them their money soonest. Because they also know that very few people keep a loan for 30 years anymore. Who stays in a house 30 years? It's really like 3 to 5 years. Now that these last couple of years have happened, with people paying so far over asking price, I have a feeling that we're going to see that statistic turn more into 8, 9, 10, 12 years that people keep a house because they probably can't afford to sell it right away because they had to pay so much to get it. So we shall see. But nonetheless, the lender's making the most of their money in the first half of the loan, as far as interest goes, right? So this $1,500 a month payment, you might only have $50 or $100 of that money bringing your loan amount down, paying down your mortgage, your actual loan amount. And most of it's going to be that profit to that lender. So be the bank, make a bunch of money, and don't buy the Maserati, be the bank. Loan money to people who have good credit. Make interest. Month 360 is the opposite. A little bit of his left going toward interest. The most of it is going toward paying down your loan. We talked about how the word mortgage or amortization, mort, that little fragment of a word means that the death of the loan. We're paying that loan down to zero over time so that we start way up here with this blue line and we work our way down to nothing on that last payment. We have a couple of options. You could have a fully amortized loan, in which case, just by making that $1,500, for example, payment every month for 360 months, you're going to end up with a zero loan balance. You've paid the whole loan off. Congratulations. You could have done that with a fixed rate mortgage. You could have done it with an adjustable rate mortgage. What's an adjustable rate mortgage? You tell me. What's an adjustable rate mortgage? You can put it in the chat. You can speak up. Your choice. Yeah, you got it. That rate that your payment is going to be based on will be lower the first year and then a little higher probably, or it will change. Let's say that it will adjust, but usually up. Exactly. Joseph's been around the block. He knows what's up. Probably going to go up. It's based on a published index. You see, once upon a time in the morning, you would hear a thud on your front door and you open the door and it's because someone threw a newspaper on your porch. We don't have those anymore, but we do have published indexes. You can look up published indexes like a 20-year treasury bill or all kinds of fun stuff that's boring in the paper. And that adjustment to the rate will be dependent on some sort of a published index like that. But what I find is that if you get a loan from a credit union, a lot of times their mortgages are going to be ARMs, adjustable rate mortgages. That's the acronym for adjustable rate mortgage. And we also saw them used improperly. We saw them kind of used almost predatorily, or at least poorly, leading up to 2008. Because people would use them when they really were trying to get into a house that they probably couldn't afford. And so the lender would say, well, if we do an adjustable rate mortgage, we could calculate it on a lower interest rate the first year. Then it will adjust after that. But by then you'll probably get that raise. By then you'll probably have those credit cards paid off. And then what happened? The raise didn't happen. The credit cards didn't get paid off. They opened a new credit card account. It got worse. And then the rate kicked in, the higher rate, and then they had a higher payment and they weren't any better off. In fact, they lost their house because they couldn't keep up anymore. They were already buying at their top max ability. And then all of that happened and they couldn't hang on. Another thing that we saw was interest-only options. So the lender would say, hey, good news. You can make your full house payment of $1,500 a month that will pay down some of your loan balance. Or if you can't quite swing $1,500, no problem. Just make a $1,200 payment. And that's called interest only, which means it's only money coming to us. It's not helping you at all. It's not paying your loan down. And so I think some people might have gotten a little addicted to that lower payment, a little bit used to it. Oh, it's a 30-year mortgage. So what? What if I make a few of these interest-only payments? I'll catch up later. And then they just never did. And they had a loan balance that never went down. They weren't paying their mortgage down because they kept making only interest payments. When we get a mortgage, we need to look at some terms. A lot of terms that matter in this chapter. We call it a mortgage a lot. Everybody calls it a mortgage. But in North Carolina, the official term is not mortgage. It's deed of trust. But it's the same idea. And what a mortgage is, or what a deed of trust is, whichever way you want to call it, is you, the borrower, telling the lender that, yes, I will agree up front that you can take the house if I don't keep paying. You're pledging the property as collateral for the loan. And that's why they're willing to loan you $500,000 or $300,000. That's a lot of money to loan somebody. Why would somebody go to that much risk? Because they stand to gain the whole property if you screw up. And the way they do that is written down and recorded in the form of in North Carolina, deed of trust. South Carolina calls it a mortgage, by the way. North Carolina calls it a deed of trust. There are differences in how it's handled, but it accomplishes the same goal of pledging the property as collateral. So, the deed of trust or mortgage pledges the property as collateral, but then there's this other thing that you also have to sign when you buy called the promissory note. So there's two documents. There's a lot of documents, but the two main documents are the mortgage and the promissory note. Let's do it this way. We've got let's call it the right word since we're in North Carolina, the deed of trust and the promissory note. Who has ever borrowed money to buy a car? Hands up in the window. Yeah. Guess what? Did you pay cash for that car? Then you signed a promissory note, right? Because on that promissory note, it showed the interest rate. It showed the number of payments. It showed the total loan amount that you borrowed, the terms and conditions of the loan. You signed something saying, yep, I acknowledge to you, the lender, that I owe you this stuff. I'm going to borrow this money based on these terms. Might have had some other terms in there too. When it comes to real estate, these same things apply, but there's a few more conditions and clauses in there. There's something called an acceleration clause, which we'll learn about in a moment. But I'll give you a little hint. It means if you're late, then you have to pay the whole loan back right away, if they want you to. They accelerate the whole loan if you let down your end of the bargain. Acceleration clause. Another one is the alienation clause. I think of the acceleration clause as sort of a sad face because that's sort of like a punishment. And I think of the alienation clause as a happy face because you've chosen to fire off this one. You've chosen to make this alienation clause happen, and it's probably for a good reason. Another word for it is the due on sale clause. You have chosen to sell your house, your property. And because you're selling your property, the lender says, well, then you got to pay us our entire loan balance. You can't just keep that loan even though you sell the property, because if you sell the property, we won't have collateral anymore. Therefore, the alienation clause kicks in anytime you sell or refinance the property. And you're going to have to pay off the entire amount that you still owe. And so that's a part of the promissory note too. There's sometimes another provision that's not a good one. And this is only on certain types of loans, but this one is called a prepayment penalty. And I bet you can figure out what that means. Any idea what a prepayment penalty means? You got it. Why does a lender want to charge you a penalty for paying off the loan early? You're already paying them interest. What's their problem? Why are they being such jerks about it? Because you're not paying them all that interest they were counting on. 360 months worth on a 30-year loan. They want interest for every payment along the way. All of these. But now you're stopping it short right here by selling the property or refinancing it to another lender. either case, you're paying them off the entire amount you borrowed early, and they are being basically shorted that amount of interest. And so some loan types have this built in. They're like, well, we'll show you. If you're going to try to do us out of that extra interest we were counting on, we'll just charge you a penalty for doing it. But here's the testable part. Not allowed for VA or FHA loans. We'll learn what those are in a little while. Can't have a prepayment penalty for those kind. It's also not allowed in North Carolina for certain primary residence loans to a certain price point. They are not uncommon, or at least I see them pop up on refinances. Refinances, you need to read that fine print. And as a broker counseling people who are considering either selling, but they might, instead of selling, they might do a refinance, let them know, we'll read the fine print, because make sure you know if there's a prepayment penalty, because they like to throw that in there. Now, that promissory note is the terms of the loan. That's what that's about. The deed of trust is putting the property up as collateral. If I can spell it. Collateral. And the phrase you can remember that by is, if you don't pay, you don't stay. You're going to lose it. You're giving them permission to take it from you. What's the means by which they're taking it from you if they need to? If you're behind on your payment a few months, what is it called when they choose to go ahead and exercise this don't pay, don't stay provision? Yes, there you go. Foreclosure. And we're going to talk about that foreclosure process tonight too. So just keep that straight. Those two are the primary things you're signing. You're signing another 2 inches worth of documents, 2 inches thick. But these are the main ones when you go to a closing as a borrower buyer. What you're also signing, by the way, is the closing statement, also called the closing disclosure, and that's what we'll get into in the next chapter. But let's talk about promissory notes and deeds of trust. All right, so the promissory note, we've got some essential elements. First of all, it's that legal evidence of the debt that you owe the lender. You're the borrower. You owe the lender some money under these terms. The essential elements of a promissory note are the term of the loan, 30-year, 20-year. The promise to repay, it specifically must say that. I promise I'll pay it back in some kind of legalese. The borrower's signature, makes sense. It also has a provision in there that says this is a negotiable instrument. A negotiable instrument. It does not mean that you can negotiate the terms of the promissory note. Wouldn't it be nice? The rate is the rate, right? Good luck. But it means that the lender has the right to sell this promissory note to another lender while you still have it. In other words, you might start out paying your mortgage payment to Bank of America, but within the first week, now you're paying it to Wells Fargo or any other potential lender. That's what negotiable means. Bank of America lumped your loan in with hundreds of other ones of similar risk because your credit score, similar credit score borrowers, similar chances of failure or success, however you want to look at it, and sold that big package of loans to another lender. Sold it to another bank or lender. Because that other lender said, look, we want to have a bunch of loans where people owe us money for the next 30 years. Sounds pretty good to me. You cool with it? Who was with me? Who wants people to owe you money every month for the next 30 years? I would love it. Let's do it. So that other lender might say, well, that's what we want for our portfolio. The lender that you started your loan with might say, well, yeah, that sounds good, but we would rather go ahead and cash out now. Let's sell that block of loans to somebody who wants to keep them for 30 years because we want to get all our money now with a profit. Because what's that lender going to do with it? What are they going to do with that chunk of money that they just made from that other lender? They're going to turn around and loan it out to more people and make more interest. Lend it again. Yeah, Joseph. It's cyclical. It's just a circular, ongoing process. Making money along the way. So that's negotiable. The lender can transfer the debt to a third party. Now, another testable item here is that the promissory note is not recorded. There's a lot of things that get recorded. One of them is the deed. Remember, the deed gets recorded. Well, the promissory note does not get recorded. That's between you and your lender. It's not a recorded document. And that's the other difference between a promissory note and the deed of trust. Promissory note explains the terms of the loan and it does not get recorded. The deed of trust is collateral, pledging the property as collateral for the loan, and it does get recorded. You can look up your neighbor's deed of trust. It's public information, public record, but not the promissory note. And here are those other provisions in the promissory note. The acceleration clause is the one that says, look, if you miss a payment, we could choose to call the entire loan balance due. And it's up to the lender. They're going to let you get away with one payment behind or 2 or 3 or 4 or 10. Depends on how busy they are. In 2008, there were some borrowers who were a year behind. They hadn't paid a mortgage payment in a year and still had not gone into foreclosure because the banks were so backlogged. Couldn't get around to everybody. They got lucky, but I have a feeling it wasn't a fun environment to be in. Every day wondering, is this the day I'm going to get a letter saying that I'm now in foreclosure? But they got away with a long time. The other hard part of that is it's pretty hard to make up a whole year being behind too, right? Just not a good time. So that acceleration clause says we're going to accelerate the amount of time in which you have to pay your entire loan due. No longer is it the remaining 23 years left. Now you got to do it immediately because you let us down. You let down your end of the bargain. Oh, you asking, can you appeal the acceleration clause? Yeah, there are a variety of potential solutions if somebody gets behind. The first step that people mess up on is they hide. I don't know, I heard this is a myth that ostriches stick their head in the sand, but they do, right? People do this, right? People just, if I ignore it, it'll go away. And so by the time they confront it, it's so far along that they don't have as many options. But if you call that lender and say, look, I've fallen on some hard times, I've got some trouble, what can we work out? That lender just wants to keep making that interest. They just want to keep collecting that interest. And sometimes they'll work something out to help you avoid foreclosure. They might do something. They might let you roll what you're behind. Maybe if it's a short term, like a couple of months because you were in between jobs or had a medical issue, they'll let you just tack that extra couple of payments onto the loan balance so that when you do end up selling the house, you'll just pay that much more. That'd be probably the best case scenario. Or they might let you make it up with little bits along the way. Now, instead of $1,500 a month, let's call it $1,700. Oh, let's do an extra $200 a month until you catch up. Or in the event of a national or international pandemic, they might do a loan forbearance program. Remember that term? Did you hear about the loan forbearances from COVID days? In which case they let people not pay their mortgage for a whole year. What do you think happened after that year? Do you know? A couple of things could have happened. It would have been nice and preferable for the borrower if the lender would have said, well, it's been a year. You haven't been making your payment because we allowed this. And so let's just tack it on to the loan amount that you owe. Wouldn't that be nice? But most lenders didn't do that. Most lenders said, okay, it's been a year. Now let's add a couple hundred to your monthly payment until you pay us back for that whole year. Now your payment's higher. And I have a feeling some people couldn't handle that. They were kind of maybe pushed already to the max. So yeah, point is, there are some solutions. You can work out some sort of alternative payment plans. Just depends on the lender, depends on when you catch it and what your situation is. There's a couple other things you can do that we'll get to and we'll talk about in a little bit. One of them is called a short sale. If you're going to sell your property, but it's now worth less than what you need to sell for in order to pay off your loan. That's called selling it short of the full loan amount that you owe. Not short like fast, but short like less than the full amount. So the values have gone down in the market. And if you were to sell it today, let's say your loan balance is $245,000. If you were to sell it today, the value of your property is $230,000. So it's not going to be enough to pay back that $245,000. So you could ask your lender's permission to pay back less than what you owe. And that's called a short sale. And a whole lot of those happened around 2008. In fact, I had been in the business 12 years by the time 2008 rolled around, and I didn't even know what a short sale was until they were all over the place. And we all got real good at them real quick. I don't like them. They're no fun. You have to call the bank every so often and see how it's going. And the borrower, the owner, the seller calls their lender and says, look, I'm trying to sell my property, but it's going to sell for less than what I can pay you back. Lender, would you please let me give you less than I owe you? And guess what? That lender has to think about it, and they might not allow it. But you have to sit there, you have to submit an application, which means you have to write a hardship letter. Please let me do this short sale. I'm in trouble. It's got medical problems. I lost my job, this and that and the other. Basically the sad letter. Explain what the problem is. Then you have to prove that you're broke. You got to show all your stuff. You got to show all of your financial situation. Tax returns, check stubs, bank balances, your kids' balances in their savings, because don't get tricky and throw $10,000 in little Johnny's savings account and say that you don't have any money, because they'll ask for that too. They're going to squeeze that orange until there is no juice. And then they're going to say, oh, do you have credit cards that you can take a cash advance on? Go ahead and do that and give us that money too. It sounds a little like the mafia, but they're agreeing to take less than what you owe, and so they're going to try to minimize how much less than they're taking as much as they possibly can. And we'll talk even more about short sales. It is a material fact, by the way, if you're selling a house and the owner is seeking a short sale. If the owner of the house, seller of the house, needs to get a short sale, is trying to get one, you have to tell everybody. They have to disclose it. You as the broker have to disclose it because of this approval process, because it could take forever. When it's probably 2009, 2010, somewhere in there, I had one, and it was literally a year between when the seller applied for the short sale and we got the approval to do the short sale. And the buyer didn't stick around. Usually on a short sale, the first buyer doesn't end up being the buyer because they get impatient. They move on to something else that they can go ahead and close on. But the process is still going, and then the next buyer or the second, third buyer benefits from that because they don't have to wait as long. It's a whole different animal. But that is another way to avoid foreclosure, a short sale. And then while we're talking about it, the other one we're going to study is it's known as a friendly foreclosure. Basically, it's a deed in lieu of foreclosure. Deed in lieu of. Instead of. In lieu of basically means instead of. And what you're doing is saying, here's the keys to the house. I give up. I can't pay anymore. Don't put me through the foreclosure process. You can just have it back. I'll just give it back to you and move on with life. And so the problem with the deed in lieu of foreclosure, though, is that the lender can't put a deficiency judgment on the borrower if they agree to it. And lenders like to reserve that right. What's a deficiency judgment? It's something that says you carry this burden around with you even after we close on the property. Closing on the property doesn't get rid of your debt. A short sale could also result in a deficiency judgment against the seller as well. They did the short sale and it accomplished most of the debt, but the lender said it's just not quite enough to satisfy us. Therefore, good luck ever getting a car loan because you're going to have a deficiency judgment showing up on your credit until you pay us the rest of what we think you owe us. So it's just something you carry around until you pay it off. So we'll touch on more of that in a little bit. Okay, so promissory note has these provisions, and these are things you need to know. The acceleration clause. You're late. The lender has the right to say, well, you missed a payment, therefore now you have to pay us the entire loan amount. It's the first step to foreclosure. It's the thing that triggers foreclosure. But it doesn't just mean 1 month late. Again, it's up to the lender. They might give you a couple or 3 or 4 or 10 months. Their choice. Whenever they're ready and they decide they want to trigger the foreclosure process in North Carolina, the lender's going to call the trustee, because remember, we don't call it a mortgage, we call it a deed of trust. And if there's a trust, there's a trustee who handles the trust. So the trustee is basically an attorney that the lender has hired. And that attorney is going to send you a letter that says, hey, got word from the lender that you're behind on your mortgage. They've gone ahead and asked us to start the foreclosure process. So the first court date will be such and such time, 30 days from now or whenever. And so now you have a couple of options. You can now pay back what you owe and get back on track. But it's going to be the months that you're late plus a penalty or a fee, extra fee, basically to the attorney/trustee person, because now they had to step in and do some work. So you're paying back what you owe with interest and penalties to get back on track, and you can keep the house and pick it up and keep on going. But if you're already in that situation, it's probably not so easy for someone in that situation, right? That's why they're in the situation. So I don't know how many people actually are able to redeem themselves in that period of time, but that is a possibility. It's not too late. They're not absolutely going to lose it. They could maybe get a loan from Uncle Joe from Arizona or win the lottery real quick and buy their way out of this problem. That could still happen. We talked about the prepayment penalty. If you pay off that loan early, you're shorting the lender some interest. Therefore, they're going to charge you. But it's not allowed for some certain primary mortgages in North Carolina. It's also not allowed for any FHA loans or any VA loans. And then this is not automatic, right? This is just certain loans. And then this one is the other one that's pretty much always going to be in place. Because again, if you're selling the property, wouldn't it be nice if the lender just didn't care that you sold the property and you could just keep making that lender monthly payments of $1,200, even though you got the big old chunk of $400,000 for selling the house, right? That'd be a pretty sweet deal. You could do a lot with that $400,000 for maintaining that, getting that big chunk of money and just paying a mortgage payment. But the problem is the lender now wouldn't have any more collateral to feel good about, to back up the loan. Therefore, the due on sale clause, also known as the alienation clause, says if you sell it, you got to pay us what you owe us. The entire balance is due at closing whenever you transfer the property. And then again, that term negotiable means the lender can sell your note. They're going to sell it packaged up with a bunch of other notes to someone else. Terms would be the same. That it doesn't change anything to you as the borrower. You still make the same payment, same interest rate. None of that changes. You're just sending the payment to a different entity, different lender, different bank. Here's the differences between the mortgage and the deed of trust. The mortgage is what's called a two-party system. The deed of trust is a three-party system. Again, the mortgage, an example of a state using the mortgage is South Carolina. North Carolina does the deed of trust. So in North Carolina, there are three people involved, three parties. The borrower, called the grantor. Remember we saw some words that ended with OR and EE, and the OR words mean that someone is giving something. So if you just saw the word grantor and knew we were talking about mortgages, I know I would think that it might be the lender we're talking about, but it's not. It's the borrower who is the grantor, because what are they granting? They're granting the property as collateral for the loan. They're giving that as collateral. So the borrower is the grantor. The lender is benefiting from this arrangement because they are getting the property if you don't make your mortgage payment. So they are the beneficiary. And then the one who handles and facilitates and initiates the foreclosure process is the trustee. They're holding that deed of trust. They're the one that's going to send you the letter from the law firm of so-and-so. That's who's going to send you that foreclosure notice if you miss a couple payments. Another term for a state that does the deed of trust method, the three-party method, is a title theory state. Title theory state. And then we call it a non-judicial foreclosure for this method we do in North Carolina because we don't have to go sue them for the foreclosure. Sorry, the lender doesn't. But in South Carolina, states that do it with the mortgage process, the lien theory states, you can see there on the left, they go through what's called a judicial foreclosure process. They have to sue the borrower to foreclose on them. And so guess what? It takes longer. So if you want to loan money to people to buy houses, do it in North Carolina because they have to sign a deed of trust, which gives you permission up front from them to foreclose on them. And you can do it quicker and take it back from them if you need to sooner. Around 2008, there was a huge backlog in South Carolina because all these lenders had to sue a bunch of borrowers to foreclose on them. It wasn't just an automatic, oh, you already signed something saying you would agree to this back when you bought it, like there was in North Carolina. So you can kind of relate them maybe that way. So over to that left side, the mortgage type state is a two-party system. The mortgagor is the borrower. That's another confusing term. Because again, the borrower is giving the mortgage, giving the property as collateral, putting up the property as collateral. They're giving that. So that's the borrower, not the lender. The mortgagor is the borrower. And so the mortgagee is the lender. In the mortgage method, there is no trustee because it's only a two-party system. The trustee is only in the three-party system like we do in North Carolina. Is that what you're asking? You mean in North Carolina, when there is a trustee, it would be an attorney that the lender hires. They're going to carry that out because it's legal. It's legal business. The trustee would be an attorney. The mortgage theory state is known as a lien theory versus a title theory. I don't know how to remember that, except maybe title starts with the T and so does trust from deed of trust. I use any silly method I can to remember it. But they'll usually be redundant about such things. They won't probably ask you lien theory versus title theory. And so just keep that straight. We're going to use the word mortgage a lot because that's what everybody knows it as. But in North Carolina, the official term is deed of trust, not mortgage. But that's what it's accomplishing. They're both accomplishing the same thing, which is pledging the property as collateral. And the term for that, anytime you're pledging the property as security for a loan or collateral for a loan, is a big old $5 word called hypothecation. This is just level 1. Just know the definition. What's hypothecation? Oh, that's when you pledge your property as collateral for the loan. That's it. We're not deep diving here. Just a definition you'll never have to use again once you pass this class. Hypothecation pledges the property as security or puts it up as collateral. And again, that's why the lender's willing to loan you so much, because they know they can get the property if it all goes the wrong way. If you don't make your payments, they can end up with that property. We okay? All right. Some other terms. Let's see. Yep, that's it. So promissory note is the legal instrument or the legal document that outlines the loan terms, the rate, the number of payments, the amount being borrowed, and then the mortgage or deed of trust is the security instrument, the thing pledging the property as security for the loan, right? You can't just sign your name to a piece of paper because they like you and trust you. They don't know you. So you got to put something up making them feel good about loaning you all that money, and that something is the property itself. So pledging the property as security for your promise that you will pay that loan. So just like there are some essential elements of the promissory note, there are also essential elements of the deed of trust. The borrower has to sign it. The legal description of the property. If we're pledging the property as security for the loan, let's make sure it's the right one. And then it needs to be in writing. That deed of trust needs to be in writing. And also it's recorded. So the deed of trust gets recorded. The promissory note back here does not. Promissory note does not get recorded, but the deed of trust does. What's another word for deed of trust? Perfect. Thank you. There you go. And then those are the typical provisions you might find in any given promissory note and deed of trust. Maybe not the prepayment penalty, but definitely those other two, the A words, acceleration clause and alienation clause. Another word for alienation clause is the due on sale clause. The deed of trust is what we're going to focus on because that's what we do in North Carolina. But the borrower is making some promises with this deed of trust. They're saying, yep, I'll keep making my payment. If I don't pay, I don't stay. I promise I'll pay. They're also saying, I will keep up the taxes and insurance coverage. Do you think the lender cares that you keep adequate insurance on the house? You've pledged it as collateral. So they want to make sure their collateral is in good shape. It doesn't burn down, or if it does burn down, there's some insurance policy that's going to pay off from that. They want to secure it, make sure it's safe. And you, the borrower, gets to pay for that insurance policy, right? There you go. Protects the investment. Perfect. And then what is important about paying the taxes? Why does the borrower need to pay the taxes? And it's written in the deed of trust that that's required. You got it, because the property tax lien is superior to the mortgage lien. Oh, wait. Now it's all coming back around full circle. Did you hear that click in your brain? It's like, oh, yeah, okay. That property tax lien is first, and then several items down the list is finally the mortgage lien. Property tax, and then it's special assessments by the government, and then it's the bundle of the bucket of specific to the property liens. And even those specific liens are just in order of when they're recorded, not necessarily the mortgage company first. Could be a mechanic's lien, could be just anything specific to the property. So therefore, better pay those taxes. Because you could lose your property because you didn't pay the taxes. The tax in North Carolina, If you go 2 years without paying your property tax, you could lose the property to foreclosure. They give you sort of a grace. They make you make an arrangement to pay them back if you're late from 1 year. But after 2 years, your lender is going to be mad at you because you could lose that property to foreclosure for not paying your property taxes. How much are property taxes? They might be like $3,000. You didn't pay them. You lose a property because you didn't pay the $3,000 property taxes. You also have to, as a borrower, maintain the property. You can't just let it go to pot. You can't just let it go and be wasted. You can't waste the property. Part of that is cutting all the trees down. You can't clear cut it because it would make it less desirable to resell. If they took it back and wanted to sell it because they had to foreclose and you've clear cut it and made it less desirable, in order to do significant alterations, you have to ask the lender's permission too, by the way. My property here was 6 acres. This old house on 6 acres. But a developer came in behind me. They haven't built it yet, but they want to build townhouses, and they needed an acre of my property in order to finish out their main road, to have like a back entrance. And I had a loan, a mortgage. And so in order to entertain their offer to sell one of my 6 acres, I had to get my lender to give me permission to do so because I had pledged my house and 6 acres as collateral for that mortgage or for that deed of trust. And so they cared if I sold off an acre because I would have decreased the value of their collateral, right? And that's how that works. If I had wanted to, maybe the house is an old 1972 brick tri-level, and I've thought many times it'd be cool to just knock it down and put a nice new house. But if I wanted to do that, again, I'd have to get their permission. They'd have to be confident that they would still have good collateral. That's a good question, Joseph. It became such an annoyance because I bought this in 2001 and I'd paid the mortgage down. This was 2019. So the mortgage had flipped. Right now I'm paying every payment more toward the loan balance than it was the interest, which was nice. So my balance was pretty low by that point. And they required me to have an appraisal. I had to pay for an appraisal. But it turns out it wasn't just the $500 appraisal. They wanted me to get a land appraisal, which was going to be $2,000. And they were dragging their feet. It was taking forever. The buyer was threatening me to sue me for specific performance because it was taking so long. And I'm like, it's the lender. I can't help it. Well, I did the math and I realized the money that I would make from selling the acre would actually pay off the loan. And so the lender had kind of ticked me off at that point. So I'm like, well, I'll show you. How about no more interest for you? Let's just pay off the loan. Instead of me getting a nice lump sum, which I was kind of wanting and counting on to do something with, I wanted to keep the mortgage because it was still cheap money, right? Low interest rate. And I know this is first world problems. Oh, poor me. I had to pay off the mortgage. But that was an option, thankfully. And I don't underestimate and I totally appreciate the privilege there. But that was a choice I had to make just to keep the deal going and be able to sell it. Otherwise, who knows how long it would have taken the lender to finally agree. And I sure didn't want to pay for a $2,000 appraisal. So that's kind of how it all shook out. So now when I sell it in September, now that we're under contract, it'll just be I wanted to pay off a loan because that's already been done. So yeah, permission for alterations, it's collateral and they care. Make sure that you don't do something that devalues the property. Oh, tenants by the entirety. Who is that between? Oh, let's talk about that when we come back. We'll come back from break and we'll talk about this. I'll see you in 10.
trying to help, but obviously my magic wasn't strong enough because the dude's body was missing a head. So my friend decided to try to use a necromancer spell, which didn't work, which I knew it wouldn't. And apparently we contaminated the crime scene because that spell uses a lot of glitter. We were in the middle of our tournament where my friend
Let's come on back together. All right. We left off talking about deeds of trusts and promissory notes and how they matter for married people. Tenants by the entirety means people who are married, how they own it. So if you're married and let's say one of you has challenging credit and the other has great credit. She's got great credit. He doesn't have such good credit. So bad that the lender says, look, you really just can't be on the mortgage. You can't be on the loan because they won't approve you. It's only her. Only she has good enough credit for that. In that case, she would sign the promissory note, the one with the good credit, but they both still have to sign the deed of trust. Did you get that? Write that one down. They both sign the deed of trust, but they don't necessarily both sign the promissory note. Because basically they both have to agree to allow the property to be collateral for the loan. Doesn't matter about the credit, doesn't matter about can they get on the loan. They both have to sign the deed of trust, acknowledging that, look, if we don't pay, we don't stay. But only one of them in that case, where only one qualifies for the loan, only one of them would sign the promissory note. So as a broker, you ask some questions. Are you married? Well, we're basically divorced. We're cordial with each other because of the kids, but we're basically divorced. Okay, well, sorry if this sounds intrusive, but I need to know for sure. What does that mean? Because basically divorced ain't divorced. And I need to know who needs to sign things, right? I need to have all the seller's signatures on the listing agreement. And then subsequently on the closing disclosure. And then if you're buying something, obviously, who's buying it? If you're married and buying something and only one of you is going to be on the mortgage or on the loan, you both still have to sign the deed of trust. Oh, well, I thought since he was getting the loan in his name, I didn't need to show up to closing. That is incorrect. You both have to be at closing because you both have to sign the deed of trust. But only he's going to sign the promissory note because it's just going to be his name on the loan. Right? So just keep aware of that. Here's our lien theory state again. The borrower, again, is the mortgagor, the one pledging the property as collateral. They retain what kind of title? They retain legal title and equitable title. They can use it, right? They get to occupy the property. They get the legal title to it. The lender, the mortgagee, because again, this is the lien theory type of state, like South Carolina, not North Carolina. We're talking about not a deed of trust situation, but a mortgage or lien theory situation. The lender holds the promissory note and the borrower holds the legal and equitable title when it's a lien theory state. So when we flip to the next slide here in a second, it's going to say title theory state, basically North Carolina. How do you think it's done in North Carolina? We're adding a third person to the mix. We're adding a trustee. What do you think the trustee is going to hold if you had to guess? Which kind of title, legal or equitable, do you think the trustee is going to hold while the borrower holds the other one? No real reason for you to know. I think it'll just stick better if you have to think about it before you see the answer. So the question was, which kind of title will the trustee be holding? Legal title or equitable title? And most of you got that. I think all of you got that. Good job. In a title theory state, as we do it in North Carolina, deed of trust, the borrower, who is called the grantor or the trustor, they retain equitable title. The trustee retains the legal title. They're going to give it to the borrower once the borrower pays all of the loan in full in however many years. And the lender, who is the beneficiary, holds that promissory note, as they do in the other kind. So back and forth, there's lien theory, and there's title theory. Who's holding which kind? If you need me to do it again so you can screenshot it, I don't mind. There's the lien theory again. The mortgagor, the borrower, retains both legal and equitable title. And the lender gets the promissory note. And don't forget, this is the lien theory method, two-party system. There's no trustee here. This is how they do it in South Carolina. It's also a judicial process to foreclose, meaning the lender has to sue the borrower to foreclose. But then over here in the title theory state, as we do it in North Carolina, the court is involved, but it's not like suing for foreclosure. The borrower has signed that deed of trust, and in the deed of trust, it said, if I didn't pay, I didn't stay. Therefore, go ahead and you can foreclose. I give you the right to from day one. So that borrower gets equitable title. They get to use it. They get to sell it. They can lease it out. They can do all kinds of things. The trustee holds the legal title until such point as the borrower pays the loan off. Some rights of the borrower include the right to possess it, because you get to use it, live there, and also the right to quiet enjoyment, which means the lender can't just come in unannounced. They never come in. They don't come. They don't come check it out like a landlord. You own this thing. You do own it. You know, some old people will make the joke, do you own your house? And they'll say, oh, me and the bank do. No, you own your house. The bank has your house as a mortgage, as a deed of trust, as collateral for paying the mortgage, but you are the owner. You make all the decisions. You can't waste it. Can't do things to affect its value without permission from the lender. But for the most part, you are the owner, and you do have the right to enjoy it quietly. The radio turned down. No, not that. Quiet enjoyment. The lender can't just come in and check it out. More rights of the borrowers. The word defeasance basically means that they have the right to pay it off. That means canceling the mortgage debt. They can pay off the mortgage. You win that lottery, you're going to buy the nice car, and maybe you'll pay off your mortgage. You could also pay off the mortgage by refinancing, getting a lump sum from another lender and using it to pay off the current loan because you want to get out from under this current interest rate. Because this rate is at 7%, and you're going to refinance into one that's only 5%. And you're basically paying off the mortgage from the first lender because you're getting a mortgage from a different lender, right? So that's called defeasance, canceling the mortgage debt, when either you've sold it or paid it off. Remember when we talked about you get the foreclosure notice from the trustee? And they say, hey, bad news, you've been late. You've not paid for 3 months, and the lender has instructed me to start the foreclosure proceedings. There is an amount of time that the borrower can save it. They can save it from foreclosure, meaning they can scrape up the 3 months worth of payments that they're behind. They're also going to have to pay some interest and penalties, including the attorney fee to the trustee who's now started the foreclosure process. They got to pay more than just the 3 months. But if they do, they can keep the house and just carry on with life. And that is called the equity period of redemption. The equity period. That's the first amount of time up until the point at which the court date is set. And the buyer can still save the house and stay there and keep it if they can pay the money that they are behind, plus penalties and interest. It's going to be more, but they could save it. Once it has the court date, then it enters into the statutory period of redemption. The problem with that is now the buyer could get it back, but they're going to have to bid on it like anybody else. Now the property is going to auction, but it's not like necessarily that everybody's standing around the courthouse steps and somebody's talking really fast. It's online typically. It's an online bidding process. And if you're a broker helping people bid on foreclosed properties like this, you have to get certified. You have to go ahead and prepare for that in advance so that you can actually help them and log in with a certain code, because you've got to make the bid on their behalf. You've got to submit it online. And during this statutory period of redemption, if somebody bids the highest bid on the property, they do not get it that day. They have to wait. Who knows how many days the highest bidder has to wait to see if another bid comes in that's higher. It's called the 10-day upset bid period. You got it, Catherine. 10 days get triggered. And during those 10 days, another party could come along and make a higher bid. They usually make it that it's got to be at least 5% higher or some amount, like not a penny, because that would take forever, right? But 10-day upset bid period. And so say day 9 rolls around and then finally another higher bid comes along. Well, guess what? A new 10-day upset bid period. And eventually there might be enough upset bids that it gets close to what it's actually worth. So much so that someone doesn't want to even bother to upset the bid because they're like, well, I can't get it for a good enough deal. Never mind. They can have it. So it'll eventually stick and the highest bidder will get it. So just be aware of that 10-day upset bid period. And at that point, again, the buyer would just have to bid on their own property, but they're probably not able to. Otherwise, they wouldn't be in that situation. We talked about the rights of the borrower. Here are the rights of the lender. They can foreclose. And it depends on the state you're in as to what kind of foreclosure. In North Carolina, it's a non-judicial foreclosure, right? Because we signed the deed of trust. We gave them permission to take the property. If we didn't keep up our end of the bargain, don't have to sue. The lender doesn't have to sue the borrower for foreclosure. A judicial foreclosure process means they would have to take you to court and sue you for it. That's how they do it in South Carolina and other states. This other one called a strict foreclosure, that's not something we do here. It's sort of a thing where the lender forecloses, and if they get what they want out of it, and then they get the whatever's over and above that. And officially in North Carolina, with our non-judicial method, it's kind of something it's not funny, but kind of have to chuckle at, because theoretically, if there's money left after the foreclosure happens and all the debts are paid and the liens are paid and the property tax lien and whatever other liens are on there, the borrower, the person who lost it to foreclosure, would get the extra leftover money. So if the lender is able to recover what their loan amount is from the sale and the foreclosure, and any other liens are satisfied, and any money's left, the borrower would get it. But that's usually not the case. Usually nothing left. From when that foreclosure happens, there is a lineup. There's usually a list. There's an order of who gets paid. And so we've been telling you this whole time that property taxes are the first position, but we lied to you. Because when it's a foreclosure, they are actually number 2, because you got to pay for the foreclosure. The cost of the foreclosure sale, the court costs, that gets covered first. I mean, it's not a ton, but it does have to get covered and paid first. The cost of the sale, the foreclosure sale, gets paid first from the from the proceeds of the foreclosure sale, then the property taxes if they haven't been paid, then any government special assessments, on and on the way we did learn it. Liens in order of recordation would be the last one. And we mentioned this before, the lender also has the right in foreclosure to put a deficiency judgment on the borrower. Again, property has been foreclosed. You would think, oh, they're done. They lost the house. Poor folks. Terrible. Well, it could be insult to injury. They lost the house to foreclosure, and that wasn't enough for the lender to be made whole again. And so the lender put a deficiency judgment on the actual person themselves. They carry this deficiency judgment even after the sale of the property, for whether it's foreclosure or short sale, and it affects their credit score until whenever they finally pay it off. That means they could have problems getting loans, car loans, another mortgage, because they've got that deficiency judgment on their credit. So that's what we mean by a deficiency judgment. We talked about the short sale as a means to avoid foreclosure. So if it's a short sale, we are not getting foreclosed, right? It's only going to work, though, if the lender allows taking less than what they are owed. And we have to wait for their permission to do so. The borrower has to wait to see if the lender will allow it. If you as a broker list a property and that owner says, I need to do a short sale because I'm in trouble financially and I'm trying to avoid foreclosure, then you can still help them. You can still list it, but you have to list it and tell everybody, the whole world, that it's a short sale. And there's a special addendum that you would include that would need to be included with any contracts that came in, any offers that came in. And it's called a short sale addendum. And it basically says, look, this could take a while. So the buyer has the right to walk away at any time before the lender approves this thing, because we're waiting for the seller's lender to approve it. Waiting for the seller's lender to approve this short sale, and that could take a while. What's involved? The seller has to fill out that hardship letter, write one. First of all, if they're in trouble and you're the broker and you find this out and they say, what can I do? Can I avoid the foreclosure? You can say, well, we could try for a short sale if we think that we won't be able to sell it for enough to pay off the loan. And they could say, well, what do you think? Can I sell it for enough to pay off the loan? And now you as the broker are going to need to know what you're talking about and do some research and see what it's worth. What's the loan amount? $237. All right, let me see if it's enough to pay me, my commission, other closing related fees for you, and then finally have $237 to pay the lender or whatever you owe them, because maybe they're also behind a couple of months, by the way. By the way, if it's worth $370 and they need to pay the lender $237, they may very well not need to do a short sale. They could just sell it and pay the lender everything they owe them and everybody's fine. It's just, they don't have to do it. It's only when they think it's worth less than they need in order to pay the lender back. So once we acknowledge that we're going to try this short sale thing, your first step as the broker is to say, look, you need to contact your lender and order a short sale package. Tell them you need to do a short sale. Could they send you the package? And they'll mail it out and they can see a whole big checklist of all the documents that they want. That lender's going to say, we want a hardship letter. We want to see your bank statements. We want to see your tax returns. You need to have proof that you are in bad shape. Make it look as bad as it is. Kids' bank statements too. Don't hide money. What's your credit card situation? Can you get cash advances? We want everything we can get. If we're going to take less than what you owe us, we're going to minimize how much less we're having to take as much as we can. Basically is their stance. And so that seller, some sellers, by the way, are more organized than others, right? Some not so much. So you might need to help them a little bit. But you as a broker are not to You would never be an intermediary between their lender and them. Between your seller and your seller's lender, you would never wheel and deal and negotiate between them. Your part in this is the real estate sale. You can handle that part, but you're not allowed to negotiate their debt. That's more than you're allowed to do. They would need to hire maybe an attorney or somebody to help them facilitate that short sale, any sort of debt negotiation, or do it themselves, but you can't do that part. The only time you are allowed to talk to their lender is just so that you can find out how far through the process you are. And the lender would have to be given permission by that seller, borrower, for them to talk to you. But you're calling them probably every week and saying, hey, where do we stand? Do you need any other documents? How you doing, lender? Do you need another? And by the way, you have to send things over and over. I don't know who gets them. It's the same place your missing sock goes from the dryer, I think. But they will frequently say, we didn't get the tax returns and the bank stub, the bank statement. Need you to send that again. And it's just this ongoing process. And finally, after weeks and maybe months, they will assign that short sale file to a first level negotiator. And that person will talk to your seller and say, hey, here's the situation. Do you have a contract yet? By the way, you would have listed it in the meantime. And maybe a buyer would have made an offer. If a buyer makes an offer on your listing when it's a short sale, you present it. You present all offers, right? You present it to your seller. They would probably going to sign it. They're probably not going to negotiate. They're just going to sign it, say, yep, fine with me. Let's see if the lender will agree. And then you forward it up to the lender. And now they can see that not only is the seller asking for a short sale, but we have a fish on the hook. We've got a buyer interested. That's pretty good chances for maybe getting that short sale approved. They're just going to want to be happy with how much the offer is for. And so that might be a back and forth. The lender might say, well, we won't do that, but we will do this. So it's going to take a while. And it's a material fact that you're doing the short sale. And the buyer has the right to walk away, and they don't have to put up any money when it's a short sale. The buyer doesn't have to put up deposit money because who knows what might happen. This thing might blow up quite often and quite likely. So they're not expected to lose money through this deal. But it's on the seller to prove that they are financially in a difficult spot. Here's our deed in lieu of foreclosure, a way to avoid foreclosure, but could include that deficiency judgment to the borrower afterward, which might keep that borrower from wanting to do it. There's a couple other things you might run into out there in the wild when you're selling a property that it has a mortgage on it. You ever heard of a subject to sale? Subject to, meaning subject to the existing loan. It's something they teach in investment courses. And what you're doing is saying, hey, let me sell my house to you and I won't tell my lender. You just make the payments on my loan. I'm the seller. I'm going to sell it to you and you're going to be the buyer. And you just keep making my house payment for me and we don't need to bother the lender with it. But there's a problem with that. That could probably trigger the due on sale clause if they found out about it. Right? And then what? So the foreclosure deficiency is not the buyer's responsibility. It's not often used because it could trigger that alienation clause because you're doing it without the lender's knowledge. Another one would be a loan assumption where the buyer's making payments on the seller's loan, but they have to get approved. A qualifying assumable loan would mean the buyer is going to assume the current loan that's on the property in order to get that interest rate. It might be something that has an interest rate back from when they were 3%. And if it's a qualifying assumable loan, a buyer today might be willing to try to qualify to assume that loan because they're going to get a 3% interest rate instead of what they're at now, like over double that. And in that event, if there's a lack of payment, a foreclosure action necessary, that foreclosure deficiency is going to be on the head of the buyer first and then the seller in a secondary position. So if the seller lets someone assume their loan, they're going to remain secondarily liable. Probably is going to keep them from wanting to even do it, right? Probably going to be a good reason for a seller to say, no, let's just sell it. I don't want to do any sort of loan assumption. But that's a possibility. Okay, let's look at a little bit of a review here. Real property tax rate stated as 9 mils would convert to what decimal? What do we do with the tax rate when we see that it's in mils? What do we divide it by? We divide 9 mils by what? And it's right there staring at you, but 9 mils, I think of the number million, which has 2 sets of 3 zeros, which makes me think of 1,000. That's just my silly way of remembering it. So 9 mils we divide by 1,000. And anytime you divide something by 1,000, the number 9 there under 9 mils is the same as saying 9.0. So that's where the decimal is. It's just hidden. So we just take that that decimal after the 9 and move it 3 places to the left. And we don't even need a calculator for that. So 9 mils put in the form of a decimal is 0.009. If it's stated the other way in dollars per hundred, well, that's a little easier because it tells you to divide by 100. It says dollars per hundred. The word per is like divided, and then there's 100. So you would, again, the decimal this time is before the 9 because it's 90 cents per hundred. So we're going to move it 2 places to the left. 2, because we're dividing it by 100, and the number 100 has 2 zeros. So that's, again, the same decimal as it would be if it were 9 mils. The provision in an executory contract that requires the performance of an action before the contract is executed. Holy cow. It's a lot of legal sounding terms here. Let's dissect it. We have an executory contract. What does that mean? What phase are we in if it's executory? Provision in an executory contract. Are we done? No. It's pending. Thank you, Marcus. Executory contract that requires the performance of an action. Something has to be done in order to close. Something has to be done in order to close. What is it? Yeah, it's contingent on something. It's contingent on a thing happening. The word is contingent, so C would be the best answer there. Yes, if you needed to change a contract, you would do it with an amendment, so that's a good point. But in order for an action to take place in order to close, an example of a contingency would be a contingent sale addendum. You would use it when you made your offer saying, look, in order for this buyer to buy this house, they're going to need to sell the house that they own now. And we can't close on yours until they close on theirs. So that would be contingent on theirs closing before they can buy yours. So a contingency is the word we're looking for there. Buyer and seller reach an oral agreement for the purchase of the seller's home. Oral agreement. Notice there's no agent in this at all, by the way. So don't let that confuse you. The buyer submits a written offer with the agreed upon terms. So they agreed orally. The buyer submitted it in writing, but the seller dies before signing the written offer. What do we have? Which of the following is true? Does the seller's estate have to honor the written offer? Is that written offer terminated because the seller didn't sign? Are the buyer and seller under contract because the buyer and seller had an oral contract? Or is it that the buyer's offer was terminated because no money changed hands? Which one? Best answer. It's not A, is it? They don't have to honor the written offer because it's just an offer. It's not a contract. If it were a contract that had gotten signed and then the seller drove home and died in a car wreck, now we have a signed contract that the estate would have to honor. But it says offer. So A can't be right. Most of you got it. I think all of you got it. The written offer is terminated because the seller didn't sign. It never made it to contract phase. And it's not D because it's not about the money. It's about offer, acceptance, and communication of that acceptance. Okay, recap. The amount you're borrowing is the loan. No surprise there. The value, the word value means the purchase price. And therefore, this thing called a loan to value ratio is the percentage of the amount you're borrowing compared to the amount of the house. And so if we have an 80% LTV and it's a $100,000 sale price, then 80% of 100,000 is going to reveal the loan amount. The loan amount is 80,000. And if we do it the opposite way, 80,000 divided by 100, that reveals the 0.8, or if we need to turn that into a percentage, the 80% loan to value ratio. So you could set it up like a T formula like this. The purchase price times the percentage LTV gives you the dollars of loan amount. That's the relationship. Sale price times LTV percentage gives you dollars of loan amount. So if the test question says, what's the LTV if we're borrowing $85,000 for a $200,000 sale price? So the loan amount is $85,000, sale price is $200,000. What's the percent LTV? Loan to value. We could also look at it that way, loan to value. And that might be a little reminder. Oh, look, let's take that 85, divide it by the 200. That means a 42.5% LTV. We borrowed 42.5%. Kind of an odd loan amount, but that's the way that works. So you'll see 80% LTV and 80%. If we borrowed 80%, if this is the entire value or sale price, and we borrowed 80% of it, then what is the amount that we didn't borrow? We borrowed 80%, so we had to put some amount down as a down payment. How much did we have to put down as a percentage? If we borrowed 80%, we had to put 20% down. There you go. So the relationship of down payment to loan amount. Loan amount, LTV, amount borrowed, all synonyms to be aware of. How much you're borrowing. The opposite of how much you're borrowing is your down payment. What's another word for down payment? Your down payment on the first day you own this thing is another way to say what? E word. How much what do you have in it? There you go. Your down payment is the amount of equity you have in the property on the first day. I say the first day because as soon as we get past that, you've got some things happening like appreciation. Property's going to increase in value probably. Maybe you tear out those Formica counters and put in granite counters. And so you increase the value because of capital improvements. So value goes up from that. Value went up because of appreciation. And then your equity also goes up because as soon as you close on that loan and make that first payment, you're paying down your loan amount. So your value is going up or your equity is going up because you are going to get more when you sell it because your loan amount went down. So all of these things is what makes real estate such an attractive investment. There's lots of ways for your equity to increase. There it is. Another way to say it. We've got a value of $250,000. We've got a loan to value ratio of 80%. And therefore, what is 80% of 250? So multiply them together with this T formula down here, shows the dollars of loan amount. That's important because every math calculation we do concerning a loan is going to be based on the loan amount, not the sale price. Let me pause for that to sink in. If you're watching Jeopardy, turn it off, pay attention. Every calculation we do related to the loan is based on the loan amount. Very common mistake is to calculate stuff on the sale price. But if it's loan related, it's the loan amount that they care about. The lender cares about it. And some of those things include discount points. That's a function of the loan amount. We're going to use the loan amount to calculate discount points when we get to that. Something called origination fee is not based on the sale price, it's based on the loan amount. The amount of interest in the first year or in a given year is based on the loan amount. How much are you borrowing? That's what the lender cares about. Lender cares about what you borrowed, not so much of what the property was worth. That'll make more sense when we dig into some problems here in a little bit. Okay, what if there was a way that you could estimate how much your monthly principal and interest payment is going to be? What if you could have some method? Anybody have an idea? Tell me, if you wanted to go house shopping and you were trying to decide, well, gosh, what can I afford? That house that I really liked that I saw online was $300,000. What would that be as a monthly payment? What would you do if you're trying to figure that out in real life? If I said in the next 60 seconds, tell me how much your payment would be on a purchase price of $300,000, putting 10% down, what would you do if you could do anything? And don't give me a school answer. You don't need a calculator. All you need is Google, right? You would probably Google search mortgage calculator, wouldn't you? Right? That's what they do on Zillow. That's what you do in the real world. That's what your consumers do. Buyers do this. They go there, but that's what you're talking about, Holly, there in the chat is some version of cost per $1,000 borrowed. Point there is those mortgage calculators are doing this behind the scenes. They know the algorithm knows, the formula knows that if you're borrowing money at 5% interest for a 30-year term, then there's a certain amount of money that's going to cost in principal and interest. So let me see if I've got something close by to share with you here. And that's what the loan factor chart is about. I believe you do have one in this book. I think it's in chapter 15, actually. And somewhere maybe around page 412, if I'm not mistaken, looks like this. The mortgage factor chart. You need to know how to handle this loan factor. And the reason for it is it's a quick way to figure out what your monthly principal and interest payment's going to be. And so the way the chart works is this. It's got the rate all the way down the side over here. That's down here. And so you can see I've highlighted the 4% rate there at the top. And then it's got 3 more columns. If your mortgage is only a 10-year loan, or a 15, or a 20, or a 25, or the most common, the 30-year term, that's the chart. And so let's say we've got a 5% loan, and it's a, just for sake of ease, because it's right there close, a 10-year mortgage. Then let's do a little cross section here and see where we end up. The loan factor on a 5% mortgage for a 10-year term is 10.61. What does that mean? That means $10.61 per $1,000 borrowed. So in other words, if you were to borrow $1,000, then your monthly mortgage payment, principal and interest, would be $10.61. Congratulations, the world's cheapest house payment. Well, that's never the house payment. It's not only $1,000 borrowed. You got to figure out how many $1,000 are in your loan amount. And so the way we use this chart is this. Let's say the loan amount is $200,000. How many thousands are in 200,000? How many $1,000 bills are you going to get from the bank if you say, give me my 200,000 balance in thousands? Oh, look, if we cross out 3 zeros, that reveals that there are 200 of them. There's $200,000 bills in a loan amount of $200,000. Just divide it by 1,000. And then since it's a 5% interest rate for a 10-year term and your loan factor is 10.61, then multiply them together. So that we've got 200 times $10.61. If you borrow $200,000, your monthly principal and interest payment's going to be $2,122. That is it. That's loan factor math. Now, on the test, I doubt they're going to give you a chart for you to have to look up your factor. They'll probably just tell you the factor. But be ready for either one. It's not a hard chart to use. Let's be a little more realistic. The rates today are much more toward the bottom of this list. Let's say we're at 6 3/4 of an interest rate. And let's say that we're going to go all the way over to a 30-year term. That last column is a 30-year mortgage because that's what by far most people get. 30-year mortgage at a 6 3/4% interest rate means our loan factor is $6.49 per $1,000 borrowed. Okay, next question is, what's the loan amount? Well, how about we see a question like this? Maybe it shows up like this. The sale price is $515,000. And the borrower is borrowing at a 90% loan to value ratio. And the loan factor is 6.49. What's the monthly payment in principal and interest? How would you do it? You can just put it in the chat when you're ready, and we'll check. This is a loan question. And as I belabored the point 10 minutes ago, we can't do much with sale price except for turn it into loan amount. So do we have what we need to turn that sale price into that loan amount? Yeah. $515,000 sale price at 90%. So our loan amount that we need is $463,500. Now that we have our loan amount and we were given our loan factor, we need to divide that loan amount by 1,000. It's 463.5 and multiply it by our factor number. And most of you got that already. $3,008 and some change is our monthly principal and interest. Not too bad, huh? Anytime you're using a mortgage calculator, this is what it's doing in the background. You just had to plug in the numbers into the fields on the screen, but it did this calculation. And so I'm sure agents back in the day, back in the olden days, carried around a little card with this chart on it so they could do this on the fly, kind of spontaneously. But nobody does that anymore. Pull up your phone, plug it in. Better yet, have them talk to a lender. Let's not give them advice on what their payment might be, because while this is nice, basic, very generic estimate, the best way is to figure out what is it for this particular buyer with their own problems and issues and advantages and disadvantages. Credit score is a big one. You could quote them a number, but what if you can't get a loan at 6 3/4 because of their credit? They have bad credit, so they're going to have to get a 7 1/4 loan. Stay out of it. Refer them to a good lender. But for the purpose of this exam, here's how you do the loan factor. There's a couple other things you need to use this on. So we will get into that. Take a look real quick. Yeah, we'll do that when we come back. I'll see you back in 10. Glad to have you, our halfway point. Let me see something here. There you go, Will. I gave you something you might could use as a last minute contingency effort. Okay. Okay, we left off here. So we've got that loan factor math. The monthly principal and interest needed to reduce the amount owed to zero. What would be the fully amortized monthly principal and interest payment? Take that loan amount there in the lower left. This case, $200,000 divided by 1,000 turns it into 200. Find the loan factor either on the chart or they give it to you. This case, it's 4.78. That's the loan factor, $4.78 per 1,000, based on the interest rate and the term. It turns out to be the first one on the chart at a 4% rate for a 30-year term. There we go. 4.78. There's a couple of 4.78s. Well, maybe not that, but there are some repeats on the chart. Not that that matters, but it's just based on the rate and the term. And then that comes up to a monthly principal and interest payment, in this case, of $956. Okay. Simple interest. How much does it cost you in interest for a year? That's what we're talking about. Simple interest means how much is it going to be in interest for a year? And so to get your simple interest on your loan, we just take the loan amount or however much is remaining. That's why it says balance due. The loan amount times the interest rate. And that's going to give you the interest for the year, the simple interest for 1 year's time. Get back to our calculation here. So it looks like this. If our loan balance is $200,000 and we have an interest rate of 4% for a 30-year loan term, multiply that loan amount by that 4%, and that shows us that in 1 year, our annual interest dollars that we pay in a year is $8,000. That's how much your interest was for the whole year based on that balance at that interest rate. We don't have to worry about compound interest. If you've ever heard of that term, we're just dealing in simple interest. So there are some calculations we need to do when we're calculating closing procedures, closing math. One of those things is called interim interest. How much is it going to cost you? How much is your lender, when you buy a house, going to charge you for the rest of the days of the first month, the month of closing? However many days left in the month of closing, they're going to charge you interest per day. And so we would need this annual interest number to figure that out, because we need to get the annual interest in order to end up with what? Daily. In order to end up with daily interest. So if our annual interest is $8,000, what do we do to calculate daily interest? I got you in the chat. I'll go into that in just a second. How do we convert our $8,000 per year into however many dollars would it be per day? How much is interest per day? Yeah, let me change that to everybody. Now everybody can see the chat. And don't forget, it's 360 days for pre-licensing, because we're assuming we're working with every month having 30 days. makes the math easier for you guys. Every month is 30 days, and therefore 12 months at 30 days each is 360 days, not 365. But you're right. That's essentially right. We divide it by the number of days in a year. So 8,000 in this case, $8,000 divided by 360 days means the dollars per day of interest is $22.22. And we'll use that in a little while. Question was, why do we divide the loan factor by 1,000? Is that right? Is that what you were asking? Yeah. That's the way they've divided it up in the chart. That's just the way they've made the chart. And if you look at that chart, oh, where'd it go? I lost my chart. This is a drawing software, so it's not as organized as I would like it to be. They've just calculated these loan factors per 1,000. So it's just because that's the way they've made the chart to be. So for every $1,000, if you read this description, it might actually help too. But there it is. The rate factor times the number of thousands, because it's divided into how many thousands are in the loan amount. And that's why we divide by 1,000. Oh, don't worry about any sort of leap year or anything tricky. The 360 is just for this class. When we hit post-licensing, post-302, it's back to normal. It's back to 365, and they're not going to get super tricky. They're just trying to test you real estate things, not calendar things. But for this class, they keep it super simple. 30-day months, therefore a 360-day year. Don't worry about leap years. Oh, there it is. Yep. So in this case, we, okay, yeah. All right. This is leading up to a problem, a test question that you're going to have to know how to do. And it's called, what is the loan balance after making the first month's payment? What's the loan balance after making the first month's payment? So what are we talking about? We get our loan, we close on the house, and once we've closed on it, and we make our first month's full mortgage payment, we paid down some of our loan, didn't we? Part of that payment, a very small part of it, paid down what we owe by just a little bit, maybe like $100. So to calculate how much you now owe after making that first payment, let's say you borrowed $200,000 originally at closing. How much do you now owe? It's not $200 anymore. Once you made your first payment, it's probably going to be $200 minus like $111. But what is the exact amount that you still owe? That's what you need to know how to be able to do. So let's look at it. Let's walk through it. We know what we need to know. We have what we need to know to accomplish this now. If you can do simple interest and if you can do loan factor math, that's all you need. But this is a several step problem, and it's okay. Don't worry. Don't let it freak you out. It's just do the steps. We'll outline the steps. So we find our loan balance because that's what matters when we're talking about the loan. We know our interest rate is 4% for a 30-year term. Therefore, we know what our loan factor is. They'll give it to you, or if they just give you the rate and the term, you can look it up on the chart. So step one, figure out what the annual interest is so that you can get the daily interest. How much is your interest per day? I'm sorry, per month, not day, per month. If you have your annual interest of $8,000, how do we know what our interest per month is? Divide the 8,000 by what? You got it. So we know that our loan amount is $200,000. We will do this several times. It's okay. If you don't get it the first time, we'll be patient. It's okay. $200,000 loan amount, 4% interest rate means that we have an annual interest in dollars of $8,000. We're paying $8,000 in annual interest. We're going to convert that into monthly interest. Divide that $8,000 by 12. That means our monthly interest portion, whatever our monthly payment is, $667 of that payment is going toward interest to the lender for the privilege of borrowing the money. Congratulations. You just made that lender $667. The next question is, well, yeah, but how much is the total payment? That was that first thing we did. We had our loan factor of 4.78. They give it to you. We know our loan amount of $200,000. The $200,000 needs to be divided by 1,000, and then take that resulting 200, multiply it by the loan factor to get our monthly principal and interest. Are we okay there? Just using the loan factor math to get the monthly principal and interest. Take the mortgage amount, divide by 1,000, and then multiply it by the factor that you're given. So our monthly principal and interest is $956. When we make our monthly payment, it's that every month. Same payment every month. What we don't know is how much of that $956 is going toward interest versus principal, is going toward interest to the lender versus principal paying down your loan. Well, on the first month, what we just figured out over here was $667 of that $956 was interest. So we combined those two things together. We figured out our loan factor total monthly principal and interest number of $956. Then we calculated our monthly interest based on that original loan amount of $200,000. And our monthly interest was $667. So here's our $956 monthly payment every month. And in month one, $667 of it went to the lender as profit. Another word you might see used in this is lender yield. Lender yield. When we talk about discount points, we talk about lender yield or profit to the lender. All right, well, if the total payment is $956 every month, and then in the first month, we paid $667 of that toward interest only, that means we reduced our principal loan amount by $289. Is that making sense? And so if the question is, how much is the loan balance after the first month's payment, then we're just going to subtract this $289, this little teensy tiny little piddly nothing amount of $289 from this big monster $200,000, right? And so $200,000 minus that little $289 of principal means that now after the first month's payment, our loan balance is no longer $200,000, it's $199,711. Right? Okay, I got a little bit of bad news for you. You might see a test question that says, what's the loan balance after the second monthly payment? And if that's the case, we do the whole thing again, except wherever we use 200, the second time through, we're going to use the 199,711. But it's all the same steps. So let's do that. But let me see. The 289, that was what we discovered was the amount we reduced the loan amount by. We reduced the loan amount by $289. How do we get that? Because we had calculated the monthly payment of $956 when we used the loan factor chart thing. And then we calculated the annual interest and turned that into monthly interest and subtracted it. Subtracted it from the monthly payment. That's how we got the 289. Does that make sense? We'll do another one together, and that'll probably lock it in a little better. Okay, what's left? So here we are. Now we're going to do the same steps again, although we don't have to do the loan factor step because that is unchanged. When we calculated the $956 per month, that's every month. So we only had to do that once. That's always our monthly P&I. So now all we need to do is figure out the monthly interest by figuring out the annual interest, but this time use the $199,711 instead of this $200. So let's see. If we do that, we plug in the $199,711 times 4% interest rate. That gives us an annual interest in dollars of $7,988. If we take that $7,988 and divide it by 12, oh look, this month, second month, the interest to the lender was $665, $2 less in month 2 than month 1. This is going to take forever, or approximately 30 years. So now that monthly interest of $665, we're just going to subtract that from the monthly payment again, like we did the first time. So this time in month 2, we reduced the loan amount by $291. And so we're going to subtract that from that $199,711. So the loan balance after month 2 becomes $199,429. This is one of the more complicated problems. So hang in there. It'll make sense, and it doesn't get any worse. So hopefully that helps. Let's look at another one. Let me just pull from air and do one with you. All right, this time, let's say we have a sale price of $340,000. We have a loan to value ratio of 80%. We have a loan factor. I'm not even going to worry. Well, I do need to give you the right stuff there. Let me pull one from the chart here. Let's go with a rate of 5% for 30 years, and the factor therefore is 5.37. Let me think. We got a factor, we got a loan amount, and we got a rate. All right. I think that's all we need. What's the loan balance? Or I guess, loan balance after the first month's payment. I'll give you a second, and then I'll walk you through it. If you get it in the meantime, go ahead and put it in. I've changed it so it'll be private. Okay, let's see what we might do here. Well, step one, we need to figure out that loan amount. So if we know the price is $340 and the loan to value ratio is 80%, multiply those together to get the loan amount of $272. If you went through this and used the sale price instead of the loan amount, that's a very common mistake to watch out for. Get that loan amount first. Now that we know the loan amount, we can calculate the monthly principal and interest. So we're going to divide that loan amount by 1,000. And then plug it into this T formula. Oops. And it's going to be the 272 times 5.37, this loan factor. And if we multiply those together, that tells us our monthly principal and interest is $1,460 and 64 cents. We okay there? So step one would be get the monthly payment by using the loan factor. Step one. Now, next thing is what do we need to do next? We know the total monthly P and I together is $1,460.64. We need to subtract just the I in order to be left with the P for that given month, right? So now we need to figure out the I. So step two. This time we're going to use the interest rate, not the loan factor. We're going to take our loan amount of $272, multiply it by the 5% interest, oops, and that shows that we have annual interest of $13,600. But what we need is monthly. So let's take our $13,600, divide it by 12, and it shows that our interest in the first month was $1,133.33. So we're going to subtract that $1,133.33 from the monthly payment. And that reveals that the amount of principal loan amount that we decreased it by with the first month's payment is $327.31. But the question is, what's the loan balance after the first payment? So we need to subtract that $327 from the original loan amount. And that shows us that our loan amount that we still owe is $271,672 and some change. Definitely. No problem. So, let's see. Let me undo. First step. Are we good on the first step using the loan factor to calculate the monthly payment? We just say, what's our loan amount divided by 1,000 and multiply that by the loan factor, in this case 5.37. That gave us our our recurring monthly P and I of $1,460.64. We good on that? The second step was calculating how much of your first month's payment of $1,460, how much of that $1,460 went toward interest to the lender? And we calculate that by taking this loan amount of $272 and multiplying it by the interest rate on the loan. $5% of $272 is how much in dollars per year we are spending on interest. But this loan amount is only good for that first month, right? Because every month after that, it's going to decrease and decrease and decrease a little at a time. So for this first month, the annual interest is $13,600. So now we're going to convert this to monthly interest by dividing it by 12 months. That's how we got this amount of interest that gets paid in the first month. So that with that first month's payment of $1,460, $1,133 of it went toward interest. And the difference between those numbers is how much your loan amount went down. So you don't any longer owe $272 after the first month's payment. You owe less than that now. How much less? Whatever the difference between these two numbers is. So 1460.64 minus 1133.33. We're gonna step 3. Take that $272 loan amount that we started with and subtract $327 from it and some change. Which leaves $271,672.69. That's our loan balance after the first month's payment. Nope. Yeah, that's right. Sorry. Now, if it went on further and said, okay, what's the loan balance after month 2? Now we're going to start with step 2 again, but we're going to replace $272,000 with $271,672 because that's our new loan balance. So if we do that, our step 2B is going to be $271,672.69 times 5% interest rate. Our annual interest this time is $13,583. We'll just round. Well, no, I'll go straight through it. Okay. And then that divided by 12 is an amount of interest of $1131.97. And so if our interest the second month is $1131.97, then how much did our principal go down by? We take that same amount of monthly payment, $1,460.64, subtract the $1131.97, and it shows that our principal loan amount went down by $328.67. So what do we subtract that from? We subtract it from the amount of the loan from the first month. The $271,672. So our loan balance after the second month is $271,344.02. I know that's a lot. I have this on the website, on the Facebook. Sorry, the YouTube channel. Where'd it go. So if you go to Impact Broker Coach and then videos and then scroll to the bottom, there it is. How to calculate your loan balance after the second month's payment. So there's one. There's probably another one around here somewhere. Here's using the loan factor to calculate your monthly principal and interest. So spend a little time on that. I promise if you do about 10 of them, you'll be like, oh, okay, I got it. This comes next. I know it seems a little daunting right now, but it does get better. Okay, some easier math. Who wants to do easier math? Here's the other kind of loan-related math you could run into. Oh, yeah, sure. Was that another one than we just did? Is that what the request was? Okay, sure. Okay, let's do another one. All right. This time, let's say sale price of 197,000. A loan to value ratio. Let's just keep it simple. Let's do a sale price of 200. Nah, not that simple. 300,000. A loan to value ratio of 75%. Get something off of this chart. This time, let's do a 6% interest rate. I don't want to be confusing. Let's do a 6.5%, which is 6.32. 6.5% interest rate at 30 years, which is a 6.32 loan factor, which just means for every $1,000 you borrow, you have to pay for monthly principal and interest payments of $6.32. I think that's all you need. What's the loan balance after month 1? Just put your answer in the chat when you're ready. Then we'll go over it. Okay. Step 1. Step 1, let's determine our monthly payment. Monthly P&I, principal and interest, by using the loan factor. We're going to do that with the loan factor and also the loan amount, which we need to calculate. So what is 75% of 300,000? 225. Times that loan factor, but let's not forget to divide it by 1,000, which knocks off those 3 zeros, which makes it 225 times 6.32, which means we have a monthly, every month payment of $14.22. That's our payment every month. Step 2, we're going to get our monthly interest. Let's call it just month's interest for that first month. We're going to do that by using that loan amount again. But this time, instead of the loan factor, we're going to use the interest rate. Because the first thing we needed to do is get the annual interest. So 225,000 loan amount times 6.5% is an annual interest of $14,625. We're going to turn that into monthly by dividing it by 12. And so our monthly interest on that very first month is $12,1875. Then we're going to get the difference between step 1 and step 2. So step 3 is take our $14.22 monthly payment and subtract the amount going toward interest the first month. Which lowers, I should say, our principal loan balance by $203. So if it lowers the balance by $203, and our loan balance originally was $225,000, that means our new loan balance after the first month's payment is $224,775. $796.75. We okay with that? Do the steps help? Now, if I need to be a jerk about it and say, okay, yeah, but what's the loan balance after the second month? We just do the same thing over again. But the good news about that is we don't have to do step one, because all that calculated was what the recurring monthly payment is. So that's the same. $14.22 a month is still the same payment. We're just going to pick it up with step two. We use a different color. Step two, this time we're going to plug in the $224, $796.75. We're going to multiply that by the rate, the interest rate again, because the rate didn't change either. And so that reveals after the second month, the annual interest we're working with is $14,611.79. And if we take that and divide it by 12, see, right now I could plug this entire big number without rounding it. I could do that divided by 12, and some of you might have done that. Or you could re-plug it in with the rounded version. They won't test you so specifically that will mess you up. They will give you answer choices that are more than a rounding error apart. So don't worry about that. But what that results in is interest of $1,217.65. We're going to, step three, subtract that from the recurring monthly payment. Which reveals that we have lowered the loan balance by $204 this time. $204.35. But we're going to subtract that from this latest loan balance of $224,796.75. So our loan balance after month 2 is $224,592.40. And that's why it takes 30 years to pay the loan off. We're creeping down little by little. Does that help? Makes sense. Turn it into steps. All the math can be this way. Turn it in, and they won't all be 4-step. We could probably make it 6 steps, but turn it into steps and do it the same way every time. And do like 10 or 15 of them. And I promise I was confused at first too. Even when I started teaching it again 5 years ago, I'm like, wait, what? So it took a little bit. But after you do a few of them, it's muscle memory. It's like, oh yeah, okay, this is the thing that comes next. And this is one of the more complicated ones. So I promise it gets better. Let's do something even easier. Probably should have started with this one, but at least now this will be super simple. Let's talk about something called origination fee. The lender charges you money. How does the lender make their money? Tell me something that the lender is doing this for. Why is the lender, they're not loaning you money out of the goodness of their heart. They're doing it to earn profit. And we've already talked about them earning something called what? So the interest is part of what they're earning, but they're business people. They're They figured out how to make lots of different money from lots of different places. So another place they will make their money besides interest is on closing costs and fees. And one of the very common fees that a lender charges is something called origination fee. And it's really just sort of an administrative fee. It's a very simple formula. And what they'll do is say, if you want this loan, you're going to have to pay an origination fee of 1%. You get one guess. 1% of what? Look at you listening to people talking and stuff. Proud. So proud. 1% of the loan amount. It's all about that loan amount. We're talking about lender stuff, so it's all about the loan amount, right? So if we had a loan amount of $200,000 and the lender charged an origination fee of 1% of the loan amount, how much would the origination fee cost in dollars? Whatever 1% of 200,000 is. Oh, look, it's $2,000. Oh, look, 1%. What's this percent sign mean? And the word percent, what is that about? Percent. Per means for every or divided by, right? Divided by. And the word cent, how many pennies are in a dollar? 100 cents are in a dollar, right? So divided by 100 is another way to think of the word percent. So when you press this percent sign, you can't see me pointing to it, but I'm pressing it. Maybe you can see it flashing. When you press that percent sign, it is dividing the number you plugged in by 100. That's what's happening. What is a percent anyway? What is this thing percent we care about? Why do we care about percent? It's talking about how much of the whole we're dealing with. So in the event of like a sale price, 100% of whatever the sale price is, if you have a 90% loan to value ratio, that means that 90% of that 100 is going towards your loan balance. That's what you're borrowing. That's how much you're borrowing. 90%, 90 per 100, 90 per 100. Not the full amount, you're borrowing 90 of it out of the 100. Does that make sense? I'm oversimplifying it so that it might help you remember the math and the relationship of the math. But that's all we're talking about here is what percent of the loan amount, if the loan amount is an entire whole, this loan amount is this entire bar graph here, we just want one little percent of it. That's how much that origination fee is. And that's all we're doing, taking 1% of the loan amount, 1% of 200,000. So obviously the easy way is to plug it in the calculator. $200,000 loan amount times 1 and the percent sign is our $2,000. Another way to, if you didn't have a calculator with a percent key, go get one. But if you don't have one, remember, anytime it's a whole number, it's the same as looking at it like this. And so if it's dividing it by 100, we're just moving it over however many zeros are in 100. In this case, 2. We're moving it over 2 decimal places. So 1% is the same thing as the decimal 0.01. That's the decimal version of 1%. And you can check that by the calculator, 1 and the percent sign. There it is, 0.01. So I don't want you to confuse what the decimal is with what the percent of it is, right? Just understand the relationship of a percent to a decimal. Now, what if they said the origination fee for this loan is 1.5% of the loan amount? This lender charges 1.5% origination fee. And it's a $200,000 loan amount that you're borrowing. How much in dollars of origination fee? How much is that origination fee going to be if it's 1% of the loan amount? I'm sorry, 1.5%. This time we're just plugging in that 200,000 times 1.5%, and there it is. Origination fee is $3,000. That's it. That's all we're doing. They will tell you how much the lender's charging for origination fee. It's probably going to be 1, could be 1.5, maybe it's 2, but in real life, it's usually 1. If they're getting really aggressive and competitive, and maybe it's half. So let's do that one. What if lender A charges 1.5%, but you have a relationship with the lender, you as the broker, and you found a lender that'll do it for 0.5% origination fee, and everything else is the same? Why wouldn't you use that lender? So how much money is the buyer saving if they use the lender that's only charging 0.5% origination fee? We have our 200,000 times 0.5 is 0.5, and then hit the percent sign. So you got it. It's $1,000 to that lender for origination compared to $3,000 for the other lender. Good? All right. So origination fee is a version of an admin. It's basically an administrative fee. That lender has full control over what they choose to charge for an origination fee. And some charge more than others. There's another thing that we need to talk about. And let's paint a scenario. Right now, the interest rate, let's say, is right at 7%. And when you calculate a payment on 7% interest, it's probably more than some people can afford. Maybe somebody was thinking about buying a house back in the summer, and life got in the way, and now they're realizing, I should have done it then, but now let's do it now. Well, the rate has gone up since then. What if they could only afford a payment based on a 6% rate instead of a 7% rate? And I just realized we have a break time. Let's pick this up in 10 minutes. I'll see you in 10. together. Knock out this last 40 minutes or so. Okay. Do a little bit more math, then we'll get into some specific loan types like conventional versus FHA and VA loans. So if you need to stand up, shake it out, get a little woken up, whatever you need to do, let's stay awake and aware. And here's our origination fee. We did it the messy way. Let's look at the nice, clean way here. Take that loan amount times the amount that they tell you for origination. In this case, $200,000 times 1%, an origination fee of $2,000. Now, let's talk about discount points. This thing called discount points. I was starting to paint a scenario for you before the break, and that is, let's say you were shopping for a house back in the summer, and back then the interest rate, let's say, was 6%. And that's the most you really could afford. And something happened, you got distracted and you didn't do anything. And so now here we are 6 months later at 7%. What if there's a way that even though the market rate right now is 7%, you've got a little bit of cash available? Maybe grandma is going to give you some money. Maybe you got some tax refund coming. And maybe you just have extra cash available. You really need a rate of 6%. What if there was a way that you could have the lender only charge you 6% instead of 7%? That's what discount points are about. Discount points let you buy down your rate. So instead of the 7% that it's at today, we can get you down to a 6% rate. Let's set that aside for a second. If you need to buy a discount point, it's basically paying upfront prepaid interest. You're telling the lender, look, I'll give you a chunk of money at closing if you'll let my interest rate go down. And over those entire 30 years of the loan, I can have that lower interest rate in exchange for an upfront chunk of money at closing. So there's some terms you need to know about. You might see it called discount points. You might see it called prepaid interest, because remember that lender's all about getting paid interest. So it's just a way to give them a chunk of interest up front instead of making them wait over the entire 360 months of a 30-year mortgage. You're giving them a chunk of it up front. You might also see it called this weird term called lender yield. Yield means like profit, what they're yielding, what they're getting. And this discount points money, this prepaid interest, this lender yield is all upfront money at time of closing in exchange for the lender letting your rate be calculated at a lower rate than what is normally possible compared to the market rate right now. So, here's something else to know. How much does a discount point cost? One discount point equals 1% of the loan amount. One discount point costs 1% of the loan amount. Remember, everything you do with the loan related fees are related to the loan amount. So on a $200,000 loan amount, if you need to buy one discount point, how much money will that cost you? You got it. $2,000. 200,000 times 1%. That's how much one discount point is going to cost you. So that's a problem. That's one of the potential calculations you could see. 1 discount point, it might say 2. How much is 2 discount points going to cost you in this same situation? Oh, do it again. $4,000. Or you could have taken the 200 and times it by 2%. Going to accomplish the same goal. Okay, here's the next thing. You know how much a discount point costs. It's 1% of the loan amount. But if you pay 1 discount point, how much does it lower your interest rate? It is not the same thing. 1 discount point is not the same thing as an interest rate point. Remember the example of we need to get down to a 6% rate instead of a 7%? That's a good guess, Joseph, and that is actually the case in real life. But for our purposes, for this class and for this exam, here's the next thing everybody needs to know. 1 discount point lowers your rate by 1/8. But you're right, Joseph. In real life, it's a quarter. I don't know why we do it differently in the class. It's just been this way forever. But it just depends on the market, I guess, and some whatever the situation is. But for you, what you guys need to know is if you have enough money to buy 1 discount point in our example, if you have an extra $2,000 available, then instead of a 7% interest rate, you're going to enjoy a 6 7/8% interest rate because you're lowering your rate by 1/8. Okay? So let's think about what that means, though. How many eighths are between 7 and 6%? A total of 1%. What's the number 1? How many? What happens when you divide the number 1 by an eighth? That's so weird. Or in this case, if we divide this number 1 into 8 pieces. Let's see, was that 1, 2, 3, 4, 5, 6, 7, 8. Here's our number 1, and it's all of these 2, 3, 4, 6, 7, 8. There are 8 1/8 in the number 1. I don't want to get too in the weeds with the math. But if you take the fraction 1/8, turn it into a decimal, that means just 1, the number 1 divided by 8. It's right there. 1 divided by 8. That's a decimal of 0.125. And so if there's 8 1/8 in the number 1, that means that 8 times 0.125 should equal 1. Oh, look, there it is. So I say all that to say this. In our original example, where the rate you could get last summer when you chose not to buy and you wish you had now was 6, and now the best you can get is 7. You need to buy enough discount points to lower that from 7% down to 6. How many discount points do you need to buy? 8 of them. 8 discount points is how much it's going to take to get from 7 to 6. And I'll show you how to figure that out in a minute. But 8 discount points? How much was 1 discount point? It was $2,000. Oh. So if you just have a spare 16 grand laying around, then your payment can be based on a 6% interest rate instead of a 7. So people aren't usually buying that many discount points down. It's usually like, oh, instead of 7%, let's get to maybe 6.5 or 6 3/4 or maybe 6 1/4. But it's not often unless they just have that extra money available, right? But that's how it works. 1 discount point buys the rate down by 1/8. So what if we saw a problem like this? the let's see, 7.25 was the rate that you could have gotten it for last month. But this month the rate has gone up, and now it's all the way up to 7.5. But you need it to be 7. You need your payment to be based on 7.25. How many discount points would you need to buy in order to turn a 7.5% rate into a 7.25% rate? What is this? I wrote it backwards, but it's really a quarter difference, isn't it? Right? 7.5 minus 7.25. Oops. They rounded. Did they round that for me? That's annoying. I don't want to round it. Oh, no. Good. They didn't. We need to buy enough discount points to lower the rate by 0.25. Another way to say 0.25 is 1/4, right? That's the fraction version. So if it needs to be lowered by 1/4, how many 8s are in 1/4? I know. You're like, dude, no fractions, please. That's obnoxious. But let me walk you through it. In case you see it on the test, you need to figure out how many discount points you're going to need to buy this rate down by this amount. You need to know how many 1/8 are in this amount. And all you need to do is remember the number 1/8 and take the number 1 and divide it by the number 8. Or you could just memorize the number. But what that equals is the decimal 0.125. So then the question is, how many 0.125s are in 0.25? And then we can plug it in the calculator. 0.25 divided by 0.125 is the number 2. And that's how many discount points we need to lower the rate from the 7.5 down to the 7.25. We need 2 discount points. And so the next question is, how much is a discount point going to cost? You tell me. Do we have enough information in what's on the screen right now to know how much a discount point is going to cost? No. We need to know the loan amount, don't we? So let me just tell you. The loan amount is $350,000. That's what we're borrowing. Now do you have what you need to determine how much it's going to cost you to buy your rate down by 2 discount points? How much is it going to cost? Two discount points, the same thing as saying 2% of the loan amount. And that just means 2% times 350,000. Which means $7,000. If you have $7,000 and you're willing to give it to that lender in the form of prepaid interest or discount points at closing, then the lender will let your mortgage payment be based on 7.25 instead of 7.5. So I don't see it pop up a lot about how many points will you need to buy the rate down by. What I do see more is how much will the discount points cost. I just want you to be ready. So I don't know that you'll run into this particular little complicated aspect of the question. And I know that's intimidating, but if you can at least, let's start with this. Let's do this discount point problem. Let's do this one. The lender charges a 1% origination fee and 3 discount points. how much will the buyer need to pay in total for both of these together? The loan amount, by the way, it's $425,000. So if a loan amount's $425,000, origination fee cost of 1%, and the discount points are 3 of them, how much will the buyer need to pay for both of those together? Origination fee plus discount points together. I see this on lots of practice exams. So you could do this a couple of different ways. You could certainly calculate 1% of 425, which would be $4,250. And then you could calculate 3% of 425, which is $12,750. And then you could add them up together, and that's $17,000, I think. Yep. Or you could acknowledge, wait a minute, 1% is how much the origination fee costs, and 3% is how much the discount points cost. So 1% plus 3% is a total of 4%. And let's just say, what is 4% of $425,000? Oh, it's the same thing. I don't care which one you do. Doesn't matter. This last method I showed you is only going to work in questions where they ask for both together anyway. So it's probably more likely that you're going to have to do them both separately anyway, so it doesn't matter. Whichever way makes sense to you, do it that way. There's lots of ways to do these things, and it doesn't matter which way you do it as long as you pick one that just sticks in your brain a little better. So either of those could work. Now, we've had a little refresher. Let's revisit this complicated one more time. Let's say let me think, how do they word it? You know, when you borrow money, that mortgage lender person that you're sitting across the desk from, asking them, hey, what'll it take? What's the interest rate? What can I make? Can I apply to get this loan? That's the loan originator. They're going to collect your information, including the loan application, and they're going to pass it off to a loan processor. They're going to put even more whipped cream on top, make it nice and neat and pretty, and collect all your most recent check stubs, bank statements, tax returns, whatever else, firstborn, all the stuff. They're going to package it up nice and easy so that the ultimate decision maker can say yes or no. And that ultimate decision maker is called the underwriter. The guidelines the underwriter goes by in determining whether or not they're going to let you have this loan are called, hang on to your butts, this is going to blow your mind, underwriting guidelines. I know, you'd have never figured that out. So that's all what's happening to decide if this loan is going to be given. But who is funding the loan? It's not any of these people. They're the ones facilitating it, putting it together, right? There's an investor out there somewhere. It's their money that's being borrowed. That investor could be an insurance company. They do something with all those extortional premiums you pay them every month or every year, right? You happy with how much you're paying for insurance? Nobody is. Only when you have to get the payout, right? But the insurance company, that's some of what they do with that money that you pay them, because they don't have to pay out unless a catastrophe happens, right? Some of that money they are investing in mortgages because they're pretty darn safe, especially the higher credit score ones. Others might be mortgage brokers, mortgage bankers, all kinds of places that we'll learn about here in a minute. So the investor is who these people are trying to figure out and make sure is protected. They're making sure that the loan they give you, they can say to this investor, yeah, it's a safe risk. Go ahead and loan them the money. This investor, the one whose money it actually is, they're not talking to you as the borrower. You don't know who they are. You're not seeing the actual people. They're certainly not the one doing the processing. They're not even necessarily the one doing the underwriting. They're the one that the underwriter is saying, yep, I'm going to tell this investor that it's safe to go ahead and loan you the money. So what you might see as a test question is that the investor wants to yield 6% from this mortgage. The one whose money is being borrowed, they want 6. But the lender, the one facilitating this thing, the originator, the processor, the underwriter, is only able to qualify this borrower when they crunch the numbers for a 5.25% interest rate. We have a problem. The investor wants 6% interest rate. He wants to charge 6. But this borrower for this house that this lender is talking to can only afford a payment based on a 5.25% rate. How much money will the discount points cost? To satisfy the investor, and make this loan happen. It's going to be the difference between the 6 and the 5.25. I say that to impress upon you kind of the roles involved here. The investor is the one whose money is being borrowed, and that investor says, I'll loan my money at 6% and not a penny less. The lender has found a potential borrower. The lender has identified a borrower who's willing and able to buy a house, but only for a maximum 5.25% interest rate. That's just how, when you do the monthly payment based on 5.25, that's how much they can afford. How can we put this deal together to satisfy the investor so they get their 6% and satisfy the borrower who can only afford 5.25%? Well, that borrower or somebody, doesn't have to be the borrower, it could be the seller, it could be the grandma, somebody's going to need to come up with 0.75, right? 6% minus 5.25%, somebody's going to need to come up with however many discount points it takes to lower the rate by this much of a percentage. I say somebody because it doesn't have to be the buyer. And in a different market than what we're in now, more competitive, like a buyer's market, when the builders actually have to compete for the few buyers that are out there, builders frequently will offer to pay points. So anyway, here's the question. We know how many points of an interest rate we need to lower it by. How many 1/8 are in this many? Okay, 0.75. Do you remember what the decimal of 1/8 actually is? it's 0.125. Remember that? When we take the number 1 and divide it by the number 8, 0.125 is the decimal version. So we just need to find out how many 0.125s are in 0.75. 0.75 divided by 0.125 is 6 points. We need to buy this rate down with 6 discount points. And so did I ever give you? No, I didn't yet. So let's say the loan amount is $200,000. How much are those discount points going to cost if the loan amount's $200,000 and we need 6 points? It's just going to be $200,000 times 6%. You got it. $12,000. And that's not crazy. I mean, buyers have maybe $40,000, $50,000 available for down payment and whatever. So maybe instead of using the entire 40 for down payment, we reserve 12,000 for discount points and we only put 28,000 down. And as long as that's fits the formula, that's 14% of 200. Yeah, that's pretty good. So that's a way that you might see this pop up. I've seen this on a test, on a practice test before. The investor wants to yield a higher number. The lender or the borrower is able to have their payment based on a lower number. Step 1, figure out the difference between those. Step 2, figure out how many 1/8 are in whatever that number is. Step 3, that's how many discount points there are, and therefore take that as a percentage of the loan amount, and that's how many dollars it's going to cost. Now the borrower's happy. They can pay $12,000 at closing and enjoy a 5.25% interest rate. The investor's happy because they got $12,000 at closing, and so now they're okay with not getting a 30 years of payments at 6%. They're going to get 30 years of payments at 5.25%. Does that logic make any sense? Is that kind of a little bit of clarity there? If you had seen this version of the test question before that explanation, I remember I was like, what? What are you talking about? That doesn't make sense. Let me tell you how much a discount point costs. So let's bring it back around here. So this is now easy compared to all that. 1 point is 1% of the loan amount. If the borrower's paying 4 discount points, that's going to be 4% of the loan amount, in this case, $8,000. And here's a little breakout of that 1/8 thing again. 1/8, 2/8, all the way up to 8/8. 8/8 means 8 divided by 8, which means 1. So that's how we know that in one interest rate amount of points, like from 7 to 6, from 6 to 5, there are 8 subdivisions, right? 8 eighths. So that's one of those questions we're asking is how many is 2/8? It's a quarter, right? 1/8 plus 1/8 is 2/8, and 2/8 reduces down to 1/4. You never knew you'd run into fractions again. Here's another version. Let's see in the white box there, $350,000 loan amount. 4.5% is what the lender stated as the interest, but the borrower wants it to be reduced to 4.25. The borrower can afford 4.25. The lender wants 4.5. So we need to reduce the interest rate by a quarter, 0.25, 1/4. And so the next question is, how many eighths are in 0.25? Another way you can do it is just to multiply that 0.25 by the number 8. That's accomplishing the same goal. And that gives you, that's probably easier, gives you 2 points. So 2 points means 2% of that 350,000. So that's going to be $7,000. Okay. Now, how do we even qualify a borrower? How do we even determine somebody is able to afford a house? The total mortgage payment, we figured when we were doing loan factor math, that was how we determined what the monthly principal and interest would be. Those top two words there, principal and interest alone, is something we can figure out by using a loan factor chart. But as we also know, somebody could fall behind on paying their property taxes and lose the property to foreclosure by the city. So therefore, the lender wants to make sure you pay your taxes also. They want to make sure you can afford to pay your taxes and insurance along with the principal and the interest. So who's heard of the acronym PITI? PITI payment, P-I-T-I. That's what it means. All four of those things. A PITI payment, a P-I-T-I payment is paying your principal, your interest, your taxes, and your insurance all in one chunk every month. So how much will your taxes and insurance be per month? What did we do when we had to figure out interest per year and turn it into per month? We divide by 12. So how much are the taxes for the year for that property? Let's say they're $2,400 for the year. What if your taxes are $2,400? How much will they be per month if they're $2,400 per year? 2,400 divided by 12. $200 extra per month for taxes. Just whatever the annual is divided by 12. And then let's say your insurance policy is $960 for the year. Divide that by 12. Oh, there's another 80. So what was that? That was 200 for insurance and then 80 200 for taxes and then 80 for insurance. So if we look back at this, whatever our principal and interest is that we figure by getting the loan factor, we're just going to add $200 more a month for taxes every month and $80 more a month for insurance. And that's what you're going to write as your house payment and send to your lender. Most lenders would rather you do this. They would rather you go ahead and send them the taxes and insurance along with your principal and interest so that they can make sure that you're paying it. Now, you could say, I don't want to do that. I want to pay you your principal and interest, and I will cover my taxes and insurance myself. And they will not like it, but they can't not let you do it. But if there's no other reason otherwise, most people just do this, the whole total PITI every month. In order to set this up so that your lender, what's happening if you pay your lender PITI? You're sending them a 12th of taxes and a 12th of insurance every month. They're keeping that 12th in an escrow account on your behalf because taxes don't get paid every month. You don't send the tax bill in every month. That gets paid once a year. And insurance might get paid once a year, maybe twice, maybe quarterly, but it's not monthly usually. So the lender's going to take that 1/12 of your year's taxes and 1/12 of your year's insurance and set it in an escrow account. Sound familiar? An escrow account's where we keep other people's money, and it's going to build up. And so when those bills come due, it's there, ready. What if something happens, the taxes go up, the insurance goes up, and there's not quite enough money in the escrow account when those bills are due? The lender tries to avoid that. They avoid that by requiring that you pad the escrow account with a few months, extra months. So when you close on a house, there it is, yeah. When you close on a house, the lender's going to tell the closing attorney, look, I want you to collect 3 months, and I'm just guessing numbers here, depends on what the lender wants. I want you to collect 3 months, 5 months for taxes, and then 6 months for insurance. Whatever they say. The attorney's going to tell the buyer, you need to bring whatever 5 months times $80 a month is for extra padding so that we can set up your insurance escrow and your tax escrow account so that when those bills come due every year, there's plenty. There's just enough there with some cushion. Now, that lender cannot just say, let's collect 14 years of cushion and then we'll reinvest that and make interest on your money. You better believe they would if they could, but that's illegal. There are guidelines and rules. There's a law against it. The lender can only collect just enough. There's a formula. There's an actual bare minimum they're allowed to keep to set up an escrow account. We'll get more into that in the next chapter, but that's why it says escrow payment. The loan payment is for the principal and interest portion. The escrow payment is for the taxes and insurance because it's going to be sitting in an escrow account until those bills come due, at which point your lender will send them off. You don't have to pay your taxes and insurance yourself. The lender's going to do it because you've been paying them a 1/12 of each of those things along the way all year long. Right? So with that said, your PITI payment has to meet a certain formula. And it depends on the type of loan you're getting as to what these ratios can be. And what this is saying is, this happens to be the ratios for a conventional loan. A conventional loan is something that you would have to have pretty good credit to get, like pretty decently high score, and a decent amount of down payment. Conventional loans are the cheapest loans to get because it's the safest borrowers who can qualify for them. So if someone needs to have less down payment, they just don't have enough money to get a conventional one, or if they have more of a challenged credit score, then they're going to need to maybe look into an FHA loan, which is something we'll get into tomorrow. So in this case, we're just dealing with a conventional loan. And so when a lender is trying to decide if you qualify, because they want to make sure you can actually pay this house payment, right? It's no fun for them to have to foreclose on people. It's expensive. It costs them time and money. If they take your house back in foreclosure, then they're going to have to turn it, flip it, put it on the market, and it's probably going to take a year. For some reason, when banks foreclose on properties, by the way, those are called REO properties, real estate owned by the bank. They want money. They work with money. They don't work with houses. It's just annoying. And it costs them time and money to take the house, get it fixed up, because if it's a foreclosure, it's probably trashed. Get a real estate agent that they trust to list it eventually when it's finally ready. And it's just snail's pace. And they want their money to be making money, and it can't make money if it's sitting in a house somewhere. So they would rather you have the best chance for success. And so they say, look, your principal, interest, taxes, and insurance payment cannot be more than 28% of your monthly gross income. That's one of the ways they qualify you for your loan. For a conventional loan, no more than 28% of your monthly gross can go toward the PITI. Just to be safe, just to increase your chances of success or decrease your chances of failure. Now, who here only pays PITI? Who here has a car payment and a credit card payment and maybe a student loan payment and maybe other recurring monthly debt, right? Normal people, regular life, real life. We've got expenses, we got bills. So the lender also cares about your extra bills too. And they say, okay, well, your PITI payment cannot exceed 28% of your monthly income. And then when we add in the amount it costs for your car payment, that ridiculous car payment that you had to have for that car you never should have bought, the one that's say $800 a month, and maybe homeowner association for this particular neighborhood, and maybe your credit cards, you got too many of those, by the way. And when you add all that in together, it cannot exceed 36% of your gross monthly income. Oh, by the way, the PITI plus all of that recurring, all of that added together cannot exceed 36%. So the PITI is included in both of these ratios. By itself, it can exceed 28% of your income. And along with your other recurring monthly debt, not including utilities, it cannot exceed 36%. That's how they qualify you. What if it does exceed 36%? Then the lender will say, do you really need that $700 car payment? Can you turn it back in? Can you get rid of it? Can you sell it? Can you burn it and collect the insurance? No, that's not good. That would be fraud. Can we get rid of the car? They're going to start picking. They're going to start saying, you have 15 credit cards. Could we get some of those paid off, or what can we do? If we could reduce some of this recurring monthly debt, we could get down below that 36% cap. And that's a real world situation. Very common conversation. I know that car is pretty, but which do you want more? The car in front of a single wide or a new house with a modest car? Either's fine, your choice, but I can't help you unless you sell the car, because what are you going to buy? So just know about those ratios. If the ratio is exceeding the 36% and they can't cut anything, the car payment, at a certain point, you need a car. And I had one lady, she was a retired lady, and her payment, I think she had just bought a car the year before, and it wasn't crazy. It was maybe $300, $290. And she was close she had to have this $300,000 new construction house. It was the only thing she liked out of everything we looked at. And we were at 44% of a PITI plus the recurring monthly payment, 44%. Well, it just so happens that when you get an FHA loan, your back end ratio, which is what you call the 36 one, your back end ratio can be 43. Another reason to go FHA instead of conventional. The ratios are more forgiving. You can have more recurring debt and still qualify. So she was going for the FHA, but she was still just a little bit over. And the conversation from the lender was, could you turn your car back in? Could you sell it? And she's like, well, how much crappier of a car do you want me to have? I'm an old lady. This is her words. I need to have a dependable transportation. She worked. And really though, from $290 to what could she possibly get for $200 so that wasn't a viable solution for her. We eventually found a lender who was willing to count. She had multiple income streams. It wasn't a ton, but a retirement account from here and a pension from over there. And they were able to count those various income streams in a way that percentage worked legally, so that the lender was happy, the investor was happy, and she could actually qualify. So that's the other lesson. If one lender can't do it, keep looking. Another one might be able to. When we come back tomorrow, we'll dig into what this qualifying the buyer actually looks like with crunching numbers. And I'll just give you a little hint. It looks something like that. So we're just going to take that monthly gross income and figure out what is 28% of it and what is 36% of it. And does the borrower qualify? And if you look in that lower right corner there, the borrower on the front end, 28% ratio, would need to make $5,357 a month. What if they make $5,500 a month gross income? Do they qualify? They do under the front end ratio of 28%, but they don't under the back end ratio of 36%. Because they would need to make $6,111 to qualify under that one. So you see how that works? So they don't qualify, right? We'll get more into that. So have a good night. Have a good day. See you tomorrow. Come up with your questions. Put your name in the chat for me, and I'll see you then.